Hello everyone, my name is Umashankar Maganti. I am a chartered accountant in practice. Simultaneously, I am also a faculty for taxation here at Masterminds. In this video, I am going to teach you whatever the amendments that are applicable for May 2023 attempt. I hope the amendments PDF is available with you. Please open it. Chapter wise, we are going to discuss about the amendments. First, we are going to discuss about amendments that are applicable in Basic Concepts chapter. First amendment is relating to surcharge. There are three types of incomes. Which are long-term capital gain under section 112A, short-term capital gain under section 111A, and dividend income. These three incomes together we call as special incomes. Generally for these three incomes, rates of surcharge of 25% and 37% are not applicable. Generally, what are the rates of surcharge in case of individual, HUF, AOP, BOI, AJP? What are the rates of surcharge? Up to rupees 50 lakhs, there is no surcharge. 50 lakhs to 1 crore, the rate of surcharge is 10%. 1 crore to 2 crores, the rate of surcharge is 15%. 2 crore to 5 crores, the rate of surcharge is 25%. Above 5 crores, the rate of surcharge is 37%. These are the rates of surcharge that are applicable. However, last two rates of surcharge are there, right? In case of 2 crores to 5 crores, the rate of surcharge is 25%. In case of if total income is greater than 5 crores, the rate of surcharge is 37%. This 25% and 37% rate of surcharge is not applicable for these three types of special incomes. It is not applicable for these three types of special incomes. Actually, this concept is already discussed in the class. But the amendment is along with these three incomes, there is also one another income which is called as long-term capital gain under section 112. Now, for these four incomes, higher rates of surcharge of 25% and 37% are not applicable. That means for these four incomes, what is the maximum rate of surcharge applicable? Maximum rate of surcharge applicable is 15%. Are you able to understand? So in class I have told you there are only three incomes: long-term capital gain under section 112A, short-term capital gain under section 111A, dividend income. For these three incomes, 25% and 37% rate of surcharge is not applicable. Now the amendment is along with these three special incomes, one more income got added. What is that? Long-term capital gain under section 112. For these four special incomes, higher rate of surcharge of 25% and 37% are not applicable. 25% and 37% are not applicable. That means what you can tell? You can tell that maximum rate of surcharge that is applicable for these four incomes is 15%. Are you able to understand? So for these four special incomes, higher rates of surcharge of 25% and 37% are not applicable. Higher rates of surcharge of 25% and 37% are not applicable. That means what? That means maximum rate of surcharge applicable for above incomes are 15%. Is it clear? Generally, in case of individual, HUF, AOP, BOI, AJP, if total income is up to rupees 50 lakhs, there is no surcharge. If total income is ranging from above, if total income is above 1 lakh and is up to 1 crore, the rate of surcharge applicable is 10%. If total income is greater than 1 crore and is up to rupees 2 crores, the rate of surcharge is 15%. If total income is greater than 2 crores and is up to 5 crores, the rate of surcharge is 25%. If total income is greater than 5 crores, the rate of surcharge applicable is 37%. Okay, even though these rates of surcharge are applicable, but for such individual HUF, AOP, BOI or AJP, if there are these special incomes, for these special incomes, you shall not apply 25% or 37% rate of surcharge. Maximum you can apply is 15% rate of surcharge. Is it clear? That is the first amendment. See, 25%, 37% percentage surcharge rates are not applicable to capital gain under section 111A under section 112. This is the amendment which is in bold, which is bold. And 112A dividend income. That means previously there are only 3 special incomes. Now for these 3 special incomes, one another income got added. Long-term capital gain under section 112A, short-term capital gain under section 111A, dividend income. To these 3 special incomes, one another income got added. That is long-term capital gain under section 112. For these 4 special incomes, 25% and 37% rate of surcharge is not applicable. Maximum rate of surcharge applicable is 15%. Are you clear with first amendment? Shall I explain the second one? First of all, association of persons. AOP means association of persons. Do you know the difference between association of persons and body of individuals? Does anyone know? Difference between association of persons and body of individuals? See, in case of body of individuals, only natural born persons can become members. Only natural born persons can become members. In case of association of persons, both natural born persons and artificial persons can also become members. I'll tell you an example. There is employees union. Do you know employees union? In big organizations, in big companies, okay, in manufacturing entities and all, there will be employees union. There will be employees union. In employees union, who will become members? Only employees can become members. All employees are natural born persons, right? All employees are natural born persons. So best example for body of individuals is employees union. In case of employees union, only employees can become members and all the employees will be natural born persons. All the employees will be natural born persons. Let's take example of Chamber of Commerce. In case of Chamber of Commerce, all business people will become members. Why business people will become members? They will solve their business related issues, trade related issues through Chamber of Commerce. So in order to solve their issues, they will become member of Chamber of Commerce. In case of Chamber of Commerce, sole proprietor can become member, partnership firm can become member, company can also become member, trust can become member, cooperative society can also become member. See, this trust, cooperative society, partnership firm, company, are they natural born persons? They are not natural born persons. Even though they are not natural born persons, still they can become member of Chamber of Commerce. So the best example for association of persons is Chamber of Commerce. In case of Chamber of Commerce, both natural born persons as well as artificial persons can also become members. Are you able to understand? So best example for body of individuals is employees union. In case of employees union, artificial person cannot become member. Okay, only natural born persons can become member. All members in the employees union are employees only who are natural born persons. However, in case of association of persons, both natural born persons as well as artificial persons can also become members. Okay, so the best example is Chamber of Commerce. In case of Chamber of Commerce, sole proprietor means he is individual, he is natural born person. That means natural born person is becoming member. Even companies are also becoming member of Chamber of Commerce. Company is artificial person. So in case of association of persons, both natural born persons as well as artificial persons can also become members. So I did not explain the amendment. I even did not explain the concept. Just till now I have explained you the difference between association of persons and body of individuals. Did you get clarity about what association of persons and what body of individuals means? Now, AOP consisting of only companies as members. What do you mean by this? There is association of persons. In case of association of persons, there will be members, right? Even natural born persons can become members, artificial persons can also become members. But this AOP has 4 members. All of them are companies only. A limited, B limited, C limited, D limited. How can we call this AOP? Can we call this AOP as AOP consisting of only companies as members? Can we call this AOP as AOP consisting of only companies as members? Yes, we can call, because this AOP consists of only companies as members. So we can call this AOP as AOP consisting of only companies as members. In case of AOP which is consisting of only companies as members, the rates of surcharge got changed. The rates of surcharge got amended. What are the rates of surcharge that are applicable for AOP consisting of only companies as members? Up to rupees 50 lakhs, there is no surcharge. 50 lakhs to 1 crore, the rate of surcharge is 10%. Above 1 crore, the rate of surcharge applicable is 15%. Very easy. Up to 50 lakhs, no surcharge. 50 lakh to 1 crore, 10%. Above 1 crore, the rate of surcharge applicable is 15%. Are you able to understand? See, we can classify AOP into two types. We can classify AOP into two types. Can we classify? We can classify AOP as all association of persons into two types. AOP consisting of only companies as members. AOP consisting of only companies as members. Oh God. AOP consisting of only companies as members. Other association of persons. Other association of persons means what? Other AOPs where along with companies, other persons will also be members. So broadly we have classified association of persons into two categories for the purpose of surcharge. AOP consisting of only companies as members, other AOPs. For these, separate rates of surcharge are applicable. Separate rates of surcharge are applicable. For other AOP, general rates of surcharge are applicable. Okay, separate rates of surcharge. Just now we have seen up to rupees 50 lakhs, no surcharge will be there. 50 lakhs to 1 crore, the rate of surcharge applicable is 10%. Above 1 crore, the rate of surcharge applicable is 15%. For other AOPs, regular rates of surcharge are applicable. What are regular rates of surcharge? Up to 50 lakh nil, 50 lakh to 1 crore, 10%, 1 crore to 2 crore, 15%, 2 crore to 5 crore, 25%, above 5 crores, 37%. These are the general rates of surcharge. For all other AOPs, general rates of surcharge are applicable. However, in case if AOP consists of only companies as members, these special rates of surcharge are applicable. Up to 50 lakhs nil, 50 lakh to 1 crore 10%, above 1 crore 15%. Are you able to understand? So have you understood first two amendments? Are they clear? Do you have any doubt? I'll give you 2 minutes, just go through them. Do you remember the rates of surcharge that are applicable to domestic company? In case of domestic company, up to rupees 1 crore there is no surcharge. Up to rupees 1 crore there is no surcharge. From 1 crore to 10 crore the rate of surcharge applicable is 7%. If the total income is greater than 10 crores, the rate of surcharge applicable is 12%. Do you remember? In case of foreign company also, up to rupees 1 crore, there is no surcharge. From 1 crore to 10 crore, the rate of surcharge applicable is 2%. If the total income is greater than 10 crores, the rate of surcharge applicable is 5%. Do you remember? Whatever the rates of surcharge that are applicable to domestic company, the same rates of surcharge are even made applicable to cooperative society. For domestic company, up to rupees 1 crore, no surcharge. 1 crore to 10 crore, 7%. Above 10 crores, the rate of surcharge applicable is 12%. The same rates of surcharge were also made applicable to cooperative society. So from now onwards, you can tell the rates of surcharge applicable to domestic company and cooperative society are one and the same. Are you able to understand? So please see, in case of cooperative society also, up to rupees 1 crore there is no surcharge. From 1 crore to 10 crores, the rate of surcharge applicable is 7%. Above 10 crores, the rate of surcharge applicable is 12%. There you can write same rates of surcharge that are applicable to domestic company. Even for cooperative society also, whatever the rates of surcharge that are applicable to domestic company, the same were made applicable. Is it clear? Do you remember the concept of marginal relief? In total income chapter, marginal relief concept would have been discussed. Even the marginal relief is also available for these new rates of surcharge that are applicable to cooperative society. Do you remember section 115 BAD? optional tax rates in case of cooperative society. That means, do you know the regular rates of tax that are applicable to cooperative society? Up to rupees 10,000, the rate of tax applicable is 10%. From 10,000 to 20,000, the rate of tax applicable is 20%. Above 20,000, the rate of tax applicable is 30%. Those are regular slab rates. However, cooperative society has an option to pay tax under optional tax rates under section 115 BAD. Do you remember? Under section 115 BAD, cooperative society has option to pay tax using optional tax rates. Cooperative society has an option to pay tax using optional tax rates. What is the tax rate that is applicable? Tax rate that is applicable is 22%. Tax rate that is applicable to cooperative society if it chooses section 115 BAD. Optional tax rate is tax rate applicable is 22%. To this tax rate, we will add surcharge at the rate of 10%. This surcharge is default 10%. If cooperative society chooses optional tax rates, mandatory surcharge applicable is 10%. Then at that point of time, this 10%, 15%, 25%, these are not applicable. If cooperative society chooses optional tax rates, by default 10% surcharge rate is applicable. So surcharge rate is 10%. Surcharge is calculated on which amount? Surcharge is calculated on tax amount, right? Do you remember? Surcharge is always calculated on tax amount. Tax is calculated on total income. Surcharge is calculated on tax amount. So how much will be the surcharge rate? 22% into 10%. It will be 2.2%, right? So how much is tax plus surcharge? 24.2%. To this we will add health and education cess also, right? HEC at the rate of 4%. HEC is calculated on tax plus surcharge amount. HEC is calculated on tax plus surcharge amount. So 24.2 into 4%. How much? 0.968%. So how much is the effective tax rate? Effective tax rate is 25.168%. Are you able to understand? This is the effective tax rate. Effective tax rate is 25.168%. Effective tax rate is 25.168%. Normally what people will do, tax is 22%, surcharge 10%, health and education is 4%, 36% effective tax rate. This is wrong. You should not calculate like this. Okay, you need to calculate surcharge on tax amount. This is the right way to calculate effective tax rate. Are you able to understand? So in case of cooperative society which chooses to pay tax under section 115 BAD, what is the effective tax rate? Effective tax rate is 25.168%. How effective tax rate was arrived? Basically, general tax rate is 22%. To that, we will add surcharge at the rate 10%, and we will also add health and education cess at the rate of 4%. Ultimately, we will arrive at effective tax rate of 25.168%. So, if cooperative society chooses to pay tax using normal tax rates, using regular slab rates, up to 10,000, 10%, 10,000 to 20,000, 20%, above 20,000, 30%. If cooperative society chooses to pay tax using optional tax rates, what is the effective tax rate that is applicable? Effective tax rate that is applicable is 25.168%. If cooperative society chooses to pay tax using normal slab rates, then what are the rates of surcharge that are applicable? Up to rupees 1 crore, nil. 1 crore to 10 crore, 7%. Above 10 crore, 12%. If cooperative society chooses to pay tax using optional tax rates, okay, irrespective of the level of income, by default 10% rate of surcharge is applicable. Is it clear? Have you understood? Next, tax rates in case of domestic company. Generally what is the, first of all, for you are appearing for May 2023 exams, right? You are appearing for May 2023 exams. For you, Finance Act 2022 is applicable. Finance Act 2022 is applicable. Finance Act 2022 applies for which previous year? Finance Act 2022 applies for previous year 2022-23. That means Finance Act 2022 applies from 1st April 2022 to 31st March 2023. In case of domestic company, in order to choose the rate of tax, you need to consider turnover of previous year 2021. You need to consider turnover of previous year 2021. If turnover of previous year 2021, if turnover of previous year 2021 is less than or equal to 400 crores, is less than or equal to 400 crores, rate of tax applicable is 25%. If turnover of previous year 2021, if turnover of previous year 2021 is greater than 400 crores, then rate of tax applicable is 30%. Is it clear? Have you understood? So in case of domestic company, for you Finance Act 2022 is applicable, that is applicable for previous year 22-23. That means you are calculating income of previous year 22-23. At that time, in order to choose the rate of tax that is applicable for domestic company, you need to check the turnover of previous year 2021. You need to check the turnover of previous year 2021. If turnover of previous year 2021 is less than or equal to 400 crores, then what is the rate of tax applicable? Rate of tax applicable is 25%. If turnover of previous year 2021 is greater than 400 crores, then rate of tax applicable is 30%. Is it clear? So these are the rates of tax that are applicable to domestic company. One more thing, if turnover for previous year 2021 is not given in the question, if turnover for previous year 2021 is not given in the question, then you need to take the rate of tax as 30%. You need to take that rate of tax as 30%. Sir would have told in the class, if no information is given with regard to turnover of previous year 2021, then in case of domestic company you need to choose 30% as rate of tax. Do you remember? So here, if total turnover or gross receipt in the previous year 2021 is less than or equal to 400 crores, mark it, not only less than but also equal to. If it is less than or equal to 400 crores, then rate of tax applicable is 25%. In any other case means what? If turnover for previous year 2021 is greater than 400 crores, then rate of tax applicable is 30%. Note, in case of a domestic manufacturing company set up and registered on or after 1st October 2019 and commences manufacture of article or thing before 31st March 2024, exercising option under section 115 BAB, 15% of income derived or incidental to manufacturing or production of an article or thing. Actually, this was given in the form of sentence. Okay. Let us divide this sentence into number of conditions, and on the basis of conditions, let us analyze section 115 BAB. See, whenever you are reading, if you come across these kind of sentences, means first divide these sentences into number of conditions, so that it will be very easy for you to remember and it will also be very easy for you to understand. Let us divide this sentence into 4 conditions. If all these 4 conditions are satisfied, then SSC can choose section 115 BAB. SSC can choose section 115 BAB. Section 115 BAB is also optional tax rates, which is applicable for domestic manufacturing company. Okay. Now, section 115 BAB. Conditions. First condition, SSE must be a domestic company. SSE must be a domestic company. Second condition, it should be engaged in manufacturing business. It should be engaged in manufacturing business. It should be engaged in manufacturing business. Third condition, it should be set up. Set up means what? Incorporated. It should be set up. It should be set up. It should be set up on or after. It should be set up on or after 1st October 2019. It should be set up on or after 1st October 2019. Fourth one, it should commence manufacturing operations. It should commence manufacturing operations on or before 31st March 2024. So we have divided that sentence into 4 conditions. Now it is very easy for us to remember. First, what is the first condition? SSE must be a domestic company. That means, tell me whether foreign company can choose section 115 BAB. Foreign company cannot choose section 115 BAB. In order to choose section 115 BAB, company should be a domestic company. That means only domestic company can choose section 115 BAB. What is second condition? It should be engaged in manufacturing business. It should be engaged in manufacturing business. First condition is it should be domestic company, and such domestic company should be engaged in manufacturing business. That means only manufacturing domestic companies can avail the benefit of section 115 BAB. Our institution is there. Our institution is engaged in service oriented business. Okay, hotels will be there. They are engaged in service. Okay, hospitals are there. They are engaged in service oriented business. Those businesses which are engaged in service, okay, services, okay, they are not entitled to, they are not eligible for section 115 BAB. In order to choose section 115 BAB, first of all, it must be domestic company, and it should be engaged in manufacturing businesses. Okay, those domestic companies which are engaged in retail, okay, retail or service business, they are not eligible to choose section 115 BAB. Is it clear? That is second condition. What is third condition? First, domestic company, it should be engaged in manufacturing business, and it should be incorporated on or after 1st October 2019. That means if any company is incorporated before 1st October 2019, whether it can choose section 115 BAB, it cannot choose section 115 BAB. Those domestic manufacturing companies which are incorporated on or after 1st October 2019, they only can choose section 115 BAB. What is fourth condition? This domestic manufacturing company which is incorporated after 1st October 2019, it should start its manufacturing operations. It should commence its manufacturing operations on or before 31st March 2024. If it starts its manufacturing operations after 31st March 2024, whether it is eligible for section 115 BAB, it is not eligible for section 115 BAB. So if all the above four conditions are satisfied, if all the above four conditions are satisfied, if all the above four conditions are satisfied, domestic manufacturing company has an option, domestic manufacturing company has an option to choose section 115 BAB, to choose section 115 BAB. See, if all these four conditions are satisfied, it is not mandatory to choose section 115 BAB, but domestic manufacturing company gets the choice. It will get the right either to pay tax under regular rates or under optional tax rates. Are you able to understand? If these four conditions are satisfied, it is not mandatory, but it will get the right. It will get the choice either to pay tax under regular rates or under section 115 BAB optional tax rates. Now, can you please tell me what is the conjunction among these conditions? Conjunction is and. And means what? All the conditions are required to be satisfied. If and only if all the conditions are satisfied, then only domestic manufacturing company is eligible to choose section 115 BAB. Is it clear? Have you understood now? Sir, what if section 115 BAB is chosen? What if section 115 BAB is chosen? If section 115 BAB is chosen, if section 115 BAB is chosen, if section 115 BAB is chosen, the tax rate applicable is 15%. The tax rate applicable is 15%. Applicable rate of surcharge is 10%. Surcharge is calculated on tax amount, right? So 15 into 10%, it will be 1.5%. Tax plus surcharge will be 16.5%. To this we will add health and education cess at the rate of 4%. 16.5 into 4%, how much? 0.66. So what is the effective tax rate? 17.168, 17.16%. So this is the effective tax rate. We have discussed regular rates for domestic company. If turnover for previous year 2021 less than or equal to 400 crores, 25% is the tax rate. If turnover for previous year 2021 is greater than 400 crores, then tax rate applicable is 30%. SSE can pay using regular rates, or if all these four conditions are satisfied, SSE can also choose section 115 BAB. If section 115 BAB is chosen, effective tax rate applicable is 17.16%. Is it clear? So are you clear with the amendments applicable, like amendments relating to basic concepts chapter? Everybody? With this, we have finished amendments that are applicable to basic concepts chapter. I'll give you 2 minutes, just go through them. If you have any doubt, please ask me. Next, amendments relating to exempted incomes chapter. You all know that whatever the expenditure that is incurred in relation to earning of an exempted income, such expenditure is not allowed as deduction as per section 14A. Best example is there is agricultural income. There is agricultural income. Whether agricultural income is taxable or exempt. Agricultural income is exempt. Agricultural income is not at all taxable. In order to earn agricultural income also, there will be certain expenditure that will be incurred by the farmer, right? He will purchase seeds, he will purchase fertilizers and pesticides, he will pay to the labor for the purpose of sowing, for the purpose of harvesting. All these expenditures will be incurred by the farmer also, right? All these are agriculture related expenditure. First of all, agricultural income, whether it is taxable or exempt, agricultural income is exempt. It is not at all taxable. So whatever the expenditure that is incurred in relation to earning agricultural income, even such expenditure is also not allowed as deduction under PGBP head or under any other head of income. The logic is whenever income is earned, that income is not taxable, that income is exempted. So even if expenditure is incurred, that expenditure is not allowed as deduction. Are you able to understand? As income is not getting taxed, expenditure is also being not allowed as deduction. Is it clear? So this is not only applicable to agricultural income, this concept applies for all exempted incomes. Are you able to understand? So whatever the exempted incomes that were earned, exempted incomes are not taxable, they are exempted. Whatever the expenditure that is incurred in relation to earning such exempted incomes, expenditure in relation to exempted incomes, it is not allowed as deduction under PGBP head or under any other head of income. Did you understand the logic? As the income is not getting taxed, as the income is getting exempted, expenditure is also not allowed as deduction under PGBP head or under any other head of income. Actually, this concept we have already explained in exemptions chapter, but the amendment is, first of all, read expenditure incurred during a previous year in relation to exempt income would be disallowed while computing total income of that previous year by applying provisions of section 14A, even though such exempt income has not been accrued or arisen or has not been received during the said previous year. What do you mean by this? Generally, expenditure incurred in relation to exempted income is not allowed as deduction. Will you agree with me or not? Yes, it is not allowed as deduction. For example, you have planted rubber trees. These rubber trees will not give yield at the end of the first year. They will not give yield at the end of the first year. There is some incubation period. They will take time up to 4 years. Up to 4 years, they will not generate any rubber. Only if rubber is generated, there will be income from such plant. Otherwise, there will be no income from such plant, right? That means after 4 years, they will start generating income. Now, after 4 years, they will start to generate income. However, from first year onwards, expenditure is required to be incurred, right? During first year only, some fertilizers and pesticides are required to be purchased, okay? And those seeds are required to be purchased and they need to be sown, okay? In first year only, let's say 40,000 expenditure was incurred. Relating to this 40,000 expenditure, when income is getting accrued after 4 years. Whether in first year, whether income is accrued or not accrued, income did not accrue. Whether income is received, income is also not received. That means during current previous year 20 to 23, expenditure was incurred, but no income was accrued, no income was received. That means whatever the exempted income that is going to be accrued in future or that is going to be received in future in relation to that exempted income, if during current previous year, if any expenditure was incurred, even this expenditure is also not allowed as deduction under PGBP head or under any other head of income. Is it clear? Not allowed as deduction under PGBP head or any other head of income. Is it clear? Even though during the current previous year, if exempted income is not accrued, if exempted income is not received, still whatever the expenditure that is incurred in relation to exempted income that is going to be received in future or exempted income that is going to be accrued in future, such expenditure is not allowed as deduction under PGBP head or under any other head of income during current previous year. Is it clear? This is the amendment. This is the amendment. There is no such rule that during current previous year exempted income should arise. Then only expenditure is not allowed as deduction. There is no such rule. Even though during current previous year exempted income is not accrued, exempted income is not received, still expenditure is not allowed as deduction. Still also expenditure is not allowed as deduction. Is it clear? So in summary, in one line we can tell one thing: irrespective of accrual or receipt of exempted income during the current previous year, expenditure incurred in relation to earning exempted income is disallowed. Is it clear? Irrespective of exempted income is accrued or received during current previous year, whatever the expenditure that is incurred in relation to earning exempted income, such expenditure is disallowed. Is it clear? There is no such rule that during current previous year exempted income should arise, then only expenditure is disallowed. There is no such rule. Even during current previous year exempted income is not accrued, exempted income is not received, still also disallowance will apply. Expenditure incurred in relation to exempted income is disallowed. Is it clear? Have you understood the point? Is it easy now? This is a very good example because exempted income is going to be accrued or received in future, but expenditure is incurred during current previous year. Even if expenditure is incurred in relation to future exempted income, such expenditure is not allowed as deduction under PGBP head or under any other head of income during current previous year. Shall I explain amendments relating to income from salaries? Shall I? Now I will give you a chart relating to this amendment. Through this chart I am going to explain. There is employee, there is employee, there is employer, employer is there, employee is also there, and along with employee there is also family member of employee or family member of employee. Employee or family member of employee. They got illness due to COVID-19. They got illness due to COVID-19. That means either employee or any family member of the employee, they got tested COVID-19 positive. They got tested COVID-19 positive. Once employee or family member of the employee gets tested in relation to COVID-19, once if they get tested COVID-19 positive, certain expenditure is required to be incurred for their medical treatment, right? In order to get them cured out of COVID-19, certain medical expenditure is required to be incurred. So, medical expenses were incurred. Medical expenses were incurred. Medical expenses were incurred. These medical expenses are reimbursed by the employer. These medical expenses are reimbursed by the employer. These medical expenses are reimbursed by the employer. Reimbursed by the employer. Let's say there is an employer to me and I am the employee. Now my family member got affected with COVID-19. And like my family member was being joined in a hospital, medical expenditure was incurred. Hospital gave medical bill of 4 lakh rupees for treatment of COVID-19 patient. Now 4 lakh rupees were paid by me. Whatever the 4 lakh rupees of COVID-19 bill that is paid by me, these 4 lakh rupees are reimbursed by my employer. Now who is incurring the expenditure ultimately? Ultimately, expenditure is being incurred by the employer. Who is receiving the benefit? Employee is receiving the benefit because I paid 4 lakh rupees, but I also received 4 lakh rupees from the employer. For me, there is no cost. However, I received benefit in the form of treatment of COVID-19 for my family member. So here expenditure was incurred, right? Medical expenses were incurred. These medical expenses are expenditure to the employer, benefit to the employee. Will you agree with me? These medical expenses are expenditure to the employer, and these medical expenses are benefit to the employee. Do you agree with me? These medical expenses are benefit to the employee. These medical expenses are benefit to the employee. However, this benefit is not taxable. This benefit is not taxable and is exempt. This benefit is not taxable and is exempt. This benefit is not taxable and is exempt. Whether any exemption is allowed without conditions? Under Income Tax Act, without keeping conditions, no exemption is allowed. So even this exemption is also allowed subject to some conditions. Generally, if any benefit is received by employee from the employer, such benefit is taxable on the head salaries. Will you agree with me? In salary side, at the time of starting, sir would have told any benefit received by employee from the employer out of employer and employee agreement is taxable on the head salaries. Here also 4 lakh rupees benefit is received by employee from the employer. Generally 4 lakhs is required to be taxable on the head salaries. But whatever the benefit that is received for treatment of COVID-19 patient, such benefit is specifically exempted. Generally, if any benefit is received by employee from the employer, such benefit should be taxable on the head salaries. Even this is also a benefit. This benefit should be taxable, but this benefit is specifically exempted. Even that exemption is also provided subject to satisfaction of some conditions. What are those conditions that we are going to see now? Are you able to understand? Now, these are the conditions. Accordingly, the central government has specified that for claiming benefit of such exemption, the employee has to submit following documents to the employer. The employee is required to submit following documents to the employer: COVID-19 positive report of the employee or family member, or medical report if clinically determined to be COVID-19 positive through investigations in a hospital or an inpatient facility by a treating physician of a person so admitted. See, without getting COVID-19 positive also, there is a loophole, right? Benefit of exemption can be claimed. Benefit of exemption can be claimed. So that's why first condition is, in order to ensure that the either employee or family member of the employee is suffering with COVID-19 positive report is required to be submitted. That is the first condition. COVID-19 positive report is required to be submitted to the employer. Second condition, all necessary documents of medical diagnosis or treatment of the employee or his family member for COVID-19 or illness relating to COVID-19 suffered within 6 months from the date of being determined as COVID-19 positive. See, the date on which he becomes COVID-19 positive, these commercial hospitals will not leave, right? They will write all kinds of tests, okay? All CT scan, blood test, urine test, every scan they will write. So from the date on which he becomes COVID-19 positive, from that date onwards, in the next 6 months, whatever the medical reports are there, all those medical reports are also required to be submitted to the employer. What is first condition? COVID-19 positive report is required to be submitted. What is second condition? The date on which he becomes COVID-19 positive, from that date onwards, in the next 6 months, whatever the medical reports that are there, all those medical reports are also required to be submitted to the employer. Are you able to understand? Third condition, a certificate in respect of all expenditure incurred on treatment of COVID-19 or illness relating to COVID-19 of the employee or of any member of his family. Now I have said that 4 lakhs is the COVID-19 bill I paid to the hospital. What is the guarantee that I paid only 4 lakh rupees? I would have paid only 1 lakh rupees and I can claim from the employer 4 lakh rupees, right? Is there any loophole? There is a loophole. That is why whatever the COVID-19 bill that is being paid, you need to obtain certificate from the hospital. You need to obtain certificate from the hospital that you have paid so and so amount as COVID-19 bill, and whatever the certificate that is given by the hospital, even that certificate is also required to be produced to the employer to ensure authenticity of the amount that is paid. Are you able to understand? So first condition is what? COVID-19 positive report is required to be submitted. Second condition, from the date on which he becomes COVID-19 positive, in the next 6 months, whatever the medical reports that are there, all those medical reports are required to be submitted. Third condition, certificate from the hospital should be taken regarding whatever the amount that is paid as bill for treatment of COVID-19 patient. Okay, if all these three conditions are satisfied, then benefit is not taxable, benefit is exempted. This is the amendment relating to income from salaries chapter. I'll give you 2 minutes, just go through them. Is it clear? Do you guys having any doubt? After drawing chart, it would be even more clearer to you. I hope so. Next, amendments relating to PGBP. See, under PGBP, under section 37, whatever the penalty that is paid, generally why penalty is paid? Penalty is required to be paid whenever any law is violated or whenever any provisions of the act is violated. Whatever the expenditure that is incurred in relation to penalty, in relation to penalty for violating the provisions of any act or for violating any law in India, whatever the penalty that is paid, that penalty is not allowed as deduction under section 37. Do you remember? The best example, there is a transport company. What is the main business of transport company? The main business of transport company is it will carry goods from one place to another place. At the time of carrying of goods from one place to another place, this transport company will carry goods in lorries or vehicles like that. At that time, these police people will have right to stop the vehicle. Right to stop the vehicle, and they will verify C-book of the vehicle. They will verify driving license of the driver. They will verify pollution certificate, whatever the documents that are required to be maintained as per Motor Vehicles Act. They will check all those documents. If all those documents are available, then police will leave the vehicle. Otherwise, police will levy challan. Police will levy fines or penalties, and they will issue challans. Whatever the fines or penalties that are paid by these transport companies, those fines and penalties are not allowed as deduction under PGBP head under section 37, because they are paying fines and penalties for violating Motor Vehicles Act that is applicable in India. So if any expenditure is incurred in relation to penalty for violating any law that is applicable in India, such penalty is not allowed as deduction. Under PGBP head. Did you understand? Generally, it is expenditure only. Client is like company is actually paying that fines and penalties. Even the company pays such fines and penalties. Such fines and penalties are not at all allowed as expenditure because they are penal in nature. Actually, it is the responsibility of the company to maintain all those documents. But company failed and company violated the provisions of Motor Vehicles Act that is applicable in India. For violating the provisions, company is forced to pay fines and penalties. Whatever the fines and penalties that are paid, they are not allowed as deduction under PGBP head. Okay, simply we can tell whatever the penalty that is paid for violating any provisions of law that is applicable in India. If any law is there that is applicable in India, that law will have certain provisions, right? If any of those provisions are violated, penalty will be levied or fine will be levied. Whatever the penalty or fine that is paid in relation to violation of any law that is applicable in India, such penalty or fine is not allowed as deduction under PGBP head. Is it clear? Not only the law that is applicable in India, even the law that is applicable outside India. That means if any law is applicable outside India, if SSC violates provisions of such law, if any penalty is paid for violation of such law, even such penalty is also not allowed as deduction. I will tell you an example. There is one supplier who is exporting Milton bottles to Australia. In Australia also there will be Customs Duty Act will be there, right? There will be Customs Act. As per Australia's Customs Act, 3 layers of packing is required to be done. This exporter done only 2 layers of packing. As per the Customs Act that is applicable in Australia, exporter is required to do 3 layers of packing. But exporter did only 2 layers of packing. Whether exporter violated provisions of customs law applicable in Australia or not? Exporter violated the provisions of law that is applicable in Australia. Now, what Australia people will do? Australian government will levy penalty on exporter for the purpose of violating the provisions of Customs Act that is applicable in Australia. Now, let's say they levied penalty of 50,000 rupees. They levied penalty of 50,000 rupees. Now whatever the 50,000 rupees that is paid by exporter in India for violating provisions of law that is applicable in Australia, these 50,000 rupees, it is expenditure to exporter. Even though it is expenditure, such a 50,000 is not allowed as expenditure under PGBP head. Are you able to understand? So whatever the penalty that is paid for violating provisions of any law that is either applicable in India or applicable outside India, such fine and penalty is not allowed as expenditure under PGBP head. Is it clear? So have you understood first point? A point. Is it clear? Are you guys having any doubt? No, right? So penalty or fine that is paid in relation to violation of provisions that are not only applicable in India but also applicable outside India. Simply for violating provisions that are applicable in India or outside India, in relation to any law, whatever the fine and penalty that is paid, it is not allowed as deduction. Is it clear? Next. Second one, to provide any benefit or perquisite in whatever form to a person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guidelines, as the case may be for the time being in force, governing the conduct of such person. You need to read B point with example. First listen to me, I will tell you, then please read B point with example. First look at me. You know pharmaceutical companies? Sun Pharma, Ranbaxy, these are all Cipla, these are all pharmaceutical companies. What these pharmaceutical companies will do, they will, if they manufacture a new drug, that means drug means don't go outside. Drug means medicine. If they manufacturing new medicine, they need to advertise that medicine, right? Otherwise, which doctor, like how doctors come to know about that medicine? Doctors will not come to know about that medicine. So after, if they manufacture a new medicine, they will appoint marketing agents. And all these marketing agents will go to the doctor. All these marketing agents will go to different doctors in that particular city or in that particular area. And these marketing agents, when they go to the doctor, first they will give the gift. To the doctor. After they give gift to the doctor, then they will explain about the new medicine that is being manufactured by pharmaceutical company and request the doctor to use this medicine, to prescribe this medicine for their patients. In that way, advertising will be done. Now, when these marketing agents directly go to the doctor, they are giving some gift to the doctor, right? So that doctor will get impressed and doctor will further promote the medicine that is being manufactured by these pharmaceutical companies. With the benefit of promotion from the doctor, they are giving some gift to the doctor. Even for doctors also, there are some medical guidelines will applicable. There will be code of conduct. They should not accept any gifts from the pharmaceutical companies. As per the medical act that is applicable to them. These doctors should not accept any gifts from the pharmaceutical companies. Now, these pharmaceutical companies are violating that medical law. That means, as per medical law, they should not give any gift to pharmaceutical companies. However, they are giving gift to the doctors. Now, whatever the expenditure that is incurred in relation to purchase of gift, such expenditure is not allowed as deduction under PGBP head. Let's say for 1,000 doctors, gifts were purchased. Each gift cost is 1,000 rupees. So 1,000 rupees into 1,000 doctors, how much it will be? Expenditure will be 10 lakh rupees. That means pharmaceutical company is spending 10 lakh rupees just to buy the gifts to give to the doctor. Now whatever the 10 lakh expenditure that is being incurred, that 10 lakh expenditure is not at all allowed as deduction under PGBP head. Is it clear? Now read B point along with example. You will understand. First read the example, then read point B. Have you understood? Have you read? Is it clear? Next, C point. Any expenditure incurred to compound an offence under any law for the time being in force in India or outside India. To compound an offence. Compound means nothing but sufficing the offence. sufficing the offense. To compound an offense under any law for the time being in force in India or outside India. An offense was committed. An offense was committed. For that offense, 2 years prosecution is there. 2 years prosecution is there. That means 2 years that person will be kept in jail. 2 years that person will be kept in jail. In order to escape from prosecution, 50 lakh rupees are required to be paid. 50 lakh rupees are required to be paid. These 50 lakh rupees are required to be paid as per the act only. In order to escape from prosecution, 50 lakh rupees are required to be paid. Now, why these 50 lakh rupees are paid? These 50 lakh rupees are paid to suffice the offense and to get back the victim, get back the person from jail. Okay, are you able to understand? So in order to suffice the offense, in order to compound the offense, if any expenditure is incurred, even such expenditure is also not allowed as deduction under PGBP head. Are you able to understand? An offense was committed. The offense may be relating to any law that is applicable in India or outside India. In order to suffice the offense or in order to compound the offense, if any expenditure is incurred, such expenditure is not allowed as deduction under PGBP head. Is it clear? Income tax is not allowed as expenditure at the time of calculation of income under PGBP head. Do you remember? Income tax is not at all allowed as expenditure. Now, previously there is no clarity whether income tax includes surcharge and health and education cess or not. Now, there is an amendment giving clarity that income tax also includes surcharge and health and education cess. That means at the time of calculation of income under PGBP head, along with adding back of income tax amount, you also need to add back surcharge and health and education cess. Income tax is not allowed as expenditure. Income tax is disallowed. So that is the reason at the time of calculating income under PGBP head, you will add back income tax. You will add back income tax. From now onwards, along with adding back of income tax, you also need to add back surcharge and health and education cess. The reason is even income tax includes surcharge and health and education cess. Are you able to understand? Any sum paid on account of any rate or tax levied on profits on the basis of or in proportion to profits and gains of any business or profession. It is clarified that the term tax shall include and shall be deemed to have always included any surcharge or cess on such tax. Hence, tax including surcharge and cess would be disallowed while computing the business income. That means not only income tax that is disallowed, even surcharge and health and education cess are also disallowed. Are you able to understand? Next, have you understood first two amendments in PGBP? Shall I explain the third amendment? Any sum payable by SSC as interest on any loan or borrowing from any public financial institution or a state financial corporation or a state industrial investment corporation, or any sum payable by SSC as interest on any loan or borrowing from a deposit taking NBFC or systematically important non-deposit taking NBFC, or interest on any loan or advance from a scheduled bank or cooperative bank other than a primary agriculture credit society or a primary cooperative agricultural and rural development bank. So what is this, sir? Let us draw a small chart for your better conceptual clarity. So there is SSC, and there is public financial institution, or state financial corporation, or state industrial investment corporation, state industrial investment corporation, or deposit taking NBFC, or scheduled bank, or cooperative bank. SSC has taken loan from any one of these institutions. SSC has taken loan. SSC has taken loan from any one of these institutions. Let's say loan taken is 100 crore rupees. Loan taken is 100 crore rupees. Applicable interest rate is 10%. Applicable interest rate is 10%. Loan taken is 100 crores. Applicable interest rate is 10%. What happened? There is SSC. SSC has taken loan from any one of these institutions. SSC has taken loan from any one of these institutions. What is the amount of loan? Amount of loan is 100 crores. Interest rate is 10%. Tell me what is the rate of what is the amount of interest that is required to be paid each year? Interest during first year will be 10 crores. During second year 10 crores. During third year 10 crores. But SSC did not pay any interest amount. SSC did not pay any interest amount. What is the accumulated interest? Accumulated interest is 30 crores. Accumulated interest is 30 crores. Now, obviously, the banker or financial institution will come to the SSC and they will ask, right? They will ask for payment of interest. They will ask for payment of interest. SSC has taken 100 crores loan. He did not repay 100 crores loan. Along with not repayment of 100 crores loan, for 3 years he did not pay any interest. For 3 years he did not pay any interest. Interest accumulated amounted to 30 crore rupees. Interest accumulated amounted to 30 crore rupees. One fine day, financial institution came to the SSC. Financial institution came to the SSC and asked the SSC to repay the interest. To pay interest amount of 30 crore rupees. SSC said that he did not have any money with him. SSC said that he did not have any money with him. SSC requested the bank to convert this interest into loan. Convert interest into loan repayable in 5 installments over a period of 5 years. 5 installments over a period of 5 years. That means every year how much interest is required to be paid? In first year he is required to pay 30 crores divided by 6, 5 crores, right? 30 crores divided by 5, 6 crores. So in first year he is required to pay 6 crores. In second year he is required to pay 6 crores. In third year he is required to pay 6 crores. In fourth year he is required to pay 6 crores. In fifth year he is required to pay 6 crores. Do you remember section 43B? As per section 43B, if any loan is taken from these banks or financial institutions, interest on such loan is allowed as deduction only on payment basis. Now here 30 crore rupees interest was converted into another loan. 30 crore rupees interest was converted into new loan. Just because interest of 30 crore rupees got converted into new loan, this will not allow any deduction. This will not give any right to claim deduction under PGBP head. As and when these 30 crores are paid, every year 6 crores are being paid, right? Every year only 6 crores can be claimed as deduction under PGBP head under section 43B. Are you able to understand? Just because interest, the nature of amount got changed. Previously the nature of amount is interest. Now the nature of amount is loan. Just because the nature of the amount got changed from interest to loan, entire 30 crores cannot be claimed as deduction during the year of conversion. Even those 30 crores also, as and when it is paid, as and when it is actually paid to the banker or financial institution, in that year only interest can be claimed as deduction under section 43B. Is it clear? Are you able to understand? Just because the nature got changed, it will not give any right to claim entire 30 lakhs as deduction during the year of conversion. Are you able to understand? As and when such interest is actually paid, then only deduction can be claimed under section 43B. Is it clear? Simply, interest under section 43B is allowed as deduction only on payment basis. Even interest got converted into loan, as and when that interest is actually paid, then only deduction can be claimed under section 43B. Read this last point. It clarifies that if any sum payable by the SSC as interest on any such loan or borrowing or advance referred to in ABC above is converted into a loan or borrowing or advance or debenture or any other instrument by which liability to pay is deferred to a future date. That's what happened, right? Actually 3 years interest is required to be paid every year, but he could not pay. That's why it is spread over a period of 5 years. It is spread over a period of 5 years. That means liability is deferred to a future date. The interest so converted and not actually paid, shall not be deemed as actual payment and hence would not be allowed as deduction. Are you able to understand? Is it clear? So these are the amendments relating to PGBP chapter. Go through them. I'll give you 2 minutes. Next, amendments relating to income from other sources chapter. Do you remember deemed dividend sections 222A, 222B, 222C, 222D and 222E? Especially 222C. What 222C speaks? At the time of liquidation, if any amount is paid to the shareholder, to the extent of accumulated profits, whatever the amount that is being paid to the shareholder, that will be considered as deemed dividend. As per section 2 subsection 22D. At the time of reduction of share capital, to the extent of accumulated profits, whatever the amount that is being paid to shareholders, even that is also to be considered as deemed dividend. So as per section 222C, 222D, at the time of liquidation or at the time of reduction of share capital, whatever the amount that is being paid to shareholders, to the extent of accumulated profits, that is to be considered as deemed dividend. Now, there are certain class of shareholders called non-participating shareholders. What do you mean by these non-participating shareholders? These non-participating shareholders will have the features of both equity shareholders and preference shareholders. Now, what is the feature of preference shareholders? They are entitled to receive certain amount of dividend, certain percentage of dividend every year. What is the feature of equity shareholders? They are entitled to have voting rights. They have right to participate in meetings and all. They have voting rights. Now these non-participating shareholders, they are equity shareholders only. They have right to receive, but they have right to receive fixed rate of dividend every year. They also have right to participate in voting. Along with that, they do not have any right to participate in surplus profits of the company. Whatever the fixed rate of dividend that they are receiving, that is only given to them. They do not have any right to participate in surplus profits of the company. Are you able to understand? So they are receiving fixed rate of dividend. Preference shares feature is there. They are entitled to participate in meetings. They have voting rights. Equity shares feature is there. But the only thing is they do not have any right to participate in surplus profits of the company. So when you say a shareholder as non-participating shareholder, there are 3 conditions. First condition is he must be receiving fixed rate of dividend every year. He should have voting rights, but he should not participate in surplus profits of the company. These shareholders we call as non-participating shareholders. In case of non-participating shareholders, at the time of liquidation or at the time of reduction of share capital, if any amount is paid to them to the extent of accumulated profits, generally if any amount is paid to the extent of accumulated profits, it will be considered as deemed dividend. But if it is paid to non-participating shareholders, it will not be considered as deemed dividend. Are you able to understand? So at the time of liquidation or at the time of reduction of share capital, if any amount is being paid to the extent of accumulated profits to the non-participating shareholders, whatever the amount that is paid, it will not be considered as deemed dividend. Are you able to understand? Is it clear? Now read. Any distribution made in accordance with distribution or liquidation or distribution on reduction of capital in respect of any share issued for full cash consideration and the holder of such share is not entitled to participate in surplus asset in the event of liquidation. Are you able to understand? Is it clear? So at the time of liquidation or at the time of reduction of share capital, whatever the amount that is being distributed to the extent of accumulated profits to the non-participating shareholder, whatever the amount that is being distributed, it will not be considered as deemed dividend. Are you able to understand? Next, basis of charge of dividend, nothing but taxability of dividend. final dividend is taxable in the previous year in which it is so declared. That means when final dividend is declared, in which previous year final dividend is declared, in that particular previous year only final dividend is taxable to the SSC. Are you able to understand? Interim dividend. Interim dividend means what? In between quarters also companies will pay dividend. For example, Infosys is there. Second quarter got over. Second quarter got over on September, on 30th September. Infosys declared interim dividend for the second quarter in October. It can declare. Okay, after completion of quarter also interim dividend can be declared by the company. When interim dividend is taxable? Interim dividend is taxable in the previous year in which such dividend is unconditionally made available. Unconditionally made available means what? In the year of receipt. In the year of receipt. So as and when interim dividend is received, in that particular previous year, interim dividend is taxable. Are you able to understand? Next, deemed dividend under section 222A, 222B, 222C, 222D. It is taxable in the previous year in which it is so distributed. Next, deemed dividend under section 222E. Do you remember this? If any loan is given by private limited company to its beneficial owner, even though loan is given, whatever the loan that is given to the extent of accumulated profits, even such loan is also to be considered as deemed dividend. Such 222E deemed dividend is taxable in the previous year in which it is so paid. That means as and when the loan is actually given to the beneficial owner, in that previous year the amount of loan is taxable as deemed dividend to the beneficial owner. Are you able to understand? Next, third amendment under income from other sources. For this, first I will draw a chart. On the basis of the chart, I will explain. Income from other sources. Section 56, subsection 2, clause 10. Generally, if any cash gift is received, if cash gift is more than 50,000, it is taxable under the head income from other sources, right? Even this is also relating to that only. First note down the chart. Any sum of money was received. Any sum of money was received. In brackets cash. Any sum of money was received. For COVID-19 treatment of SSC. For COVID-19 treatment of SSC or his family member. For COVID-19 treatment of SSC or his family member. From any person. From any person. From any person. Benefit is exempt. Benefit is exempt. What do you mean by this? There is Mr. X. There is Mr. X. Wife of Mr. X is Mrs. X. Mrs. X is suffering with COVID-19. Mrs. X is suffering with COVID-19. Mrs. X is joined in a hospital. Mrs. X is joined in a hospital. For COVID-19 treatment, 5 lakh rupees are required. For COVID-19 treatment, 5 lakh rupees are required. With Mr. X, there is no amount. With Mr. X, there is no amount. Now, to rescue, to help Mr. X, his friend Mr. Y came. Mr. Y came and Mr. Y gave 5 lakh rupees to Mr. X. Mr. Y gave 5 lakh rupees to Mr. X. Now, Mr. X used this 5 lakh rupees for the treatment of his wife, Mrs. X. Generally, Mr. X is receiving 5 lakh rupees from Mr. Y without any obligation to repay. Generally, this is a kind of gift, right? This is a kind of gift. But why this gift is received? This is received for the treatment of wife, for the treatment of for the COVID-19 treatment of family member. That means if any cash gift is received for the purpose of COVID-19 treatment of family member, such cash gift is not taxable irrespective of the amount. Are you able to understand? Is it clear? Have you understood? If any cash gift is received, generally if cash gift is more than 50,000, it is taxable on the head income from other sources. Even the cash gift is more than 50,000, if that is received for the purpose of treatment of COVID-19 of either SSC or any of his family member, then whatever the cash gift that is received, it can be received from any member. It can be received from any member. Such cash gift is not taxable. Such cash gift is exempt. Are you able to understand? Next. Have you understood first part? Second part. Any sum of money was received. That means cash gift was received. By whom? By family member of. By family members of. By family members of deceased person. Deceased person due to COVID-19. Deceased person due to COVID-19. Deceased person means what? The person who died due to COVID-19. Deceased person due to COVID-19. From employer. From employer. From employer it is exempt. From employee. From employee. Sorry. From any other person. From any other person. Up to rupees 10 lakh. Up to rupees 10 lakh exempt. In excess of rupees 10 lakh. In excess of rupees 10 lakh taxable. In excess of rupees 10 lakh it is taxable. What do you mean by this? Due to COVID-19. Due to COVID-19, SSC got expired. SSC got expired. His family members received. See, when SSC gets expired, if, for example, in a family, if father gets expired, means father is the backbone of the family financially. Father is the backbone of the family financially. Once if a family loses father, then obviously that family is going to struggle financially. Family is going to struggle financially. In order to help that family financially, some people came forward. For example, employer came forward. Father is an employee, he is working in organization. So employer is of the point that this person has worked for my company for so many years. Now this person died. Due to death of this person, his family is suffering a lot. So that's why employer came forward. Employer gave compensation of 50 lakh rupees to that family. Employer gave compensation of 50 lakh rupees to that family. Now whatever the compensation or whatever the cash gift that is received by family members of death person due to COVID-19, family members of death person due to COVID-19 from the employer of the deceased, such cash gift is exempt. Irrespective of the amount. If the compensation is paid by any other person, any person other than employer, then up to rupees 10 lakh exempt, in excess is taxable. Are you able to understand? Nothing but cash gift kanna kuda compensation ante bauntundi. If any compensation is received by family members of the person who died due to COVID-19, if compensation is received from employer, irrespective of the amount of compensation, it is fully exempt. If compensation is received from any other person up to rupees 10 lakh exempt, in excess is taxable. Are you able to understand? Is it clear? But this exemption is allowed. Whether exemption is allowed freely? No. Exemption is allowed subject to some conditions. Those conditions we are going to see now. Those conditions we are going to check now. Conditions are there. Please open. First one. Where the cause of death of such person is illness relating to COVID-19 and the payment is received within 12 months from the date of death of such person. See, what is first condition? If a person dies due to COVID-19, from the date of death of such person, within 12 months compensation should be received. That compensation can be received either from employer or from any other person. Only if compensation is received within 12 months from the date of death of the COVID-19 person, then only exemption is allowed. Otherwise exemption is not allowed. Are you able to understand? Otherwise it becomes a loophole. Even today he will pay money and he will tell he paid money relating to death of COVID-19 person. That's why this time limit was kept. Okay, from the date of death of the person due to COVID-19, within 1 year compensation should be received. Then only compensation is exempt. Otherwise compensation is taxable. Second condition, the death of the individual should be within 6 months from the date of testing of positive or from the date of being clinically determined as COVID-19 case for which any sum of money has been received by the member of the family. What do you mean by this? Person got COVID-19. He should die within 6 months. He should die within 6 months from the date on which he becomes COVID-19 positive. Then only exemption is allowed. పొరపాటున వాడు 6 months 1 day ఎక్స్పైర్ అయ్యాడు అనుకోండి, అప్పుడు కూడా ఈ ఎగ్జామ్షన్ రాదు అని చెప్తున్నారు. దిస్ ఎగ్జామ్షన్ ఈజ్ అవైలబుల్ ఓన్లీ ఇఫ్ ద పర్సన్ డైస్ డ్యూ టు COVID-19 విత్ ఇన్ 6 months ఫ్రమ్ ద డేట్ ఆన్ విచ్ హీ ఈస్ టెస్టెడ్ యాజ్ COVID-19 పాజిటివ్. దెన్ ఓన్లీ ఎగ్జామ్షన్ ఈజ్ అలౌడ్. అదర్వైజ్ ఎగ్జామ్షన్ ఈజ్ నాట్ అలౌడ్. The intention here is after 6 months if he dies means he is dying because of any other problem, not due to COVID-19. Okay, even though he got COVID-19, generally within 6 months, if he is fit means he will recover within 6 months. If he is not fit means, that means if he has any other ailments, any other diseases means he may not recover. So within 6 months only time limit given. If he dies after 6 months means rebuted assumption is, that means the assumption here is he might be died due to any other disease. Okay, that's why exemption is not allowed. Are you able to understand? Next, third condition, the family member of the individual has to keep record of the following documents. Whatever we have discussed in previously, COVID-19 positive report is required. Under salaries we have discussed it, right? COVID-19 positive report is required to be submitted from the date, like within 6 months, whatever the medical reports are there, all of them are also required to be submitted. A medical report or death certificate issued by medical practitioner or a government civil registration office in which it is stated that death of the person is related to coronavirus disease. So in order to claim this exemption, first of all COVID-19 positive report is required to be submitted, along with the death certificate is also required to be submitted, and that death certificate should specify the person is died due to COVID-19. Next, last point, the details of such amount received in any financial year has to be furnished in prescribed form to the assessing officer within 9 months from the end of the financial year or 31st December 2022, whichever is later. That means whatever the compensation that is being received either from employer or from any other person, if SSC receives compensation, SSC should disclose this information to the income tax officer. SSC should disclose this information. That means SSC should tell he received compensation from employer or from any other person and the amount of compensation to the income tax officer. What is the due date to inform to the income tax officer? Within 9 months from the end of the financial year or 31st December 2022, whichever is later. What do you mean by this? For example, SSC died on, in 2020 COVID came, right? In 2020 COVID came. SSC died on, let's say 10th December 2020. SSC died on 10th December 2020. It falls under the previous year 2021, right? It falls under the previous year 2021. Within 9 months from the end of the financial year. What is the end of financial year previous year 2021? End of financial year is 31st December 2021. Sorry, 31st March 2021, right? 31st March 2021. From the end of the financial year, you need to take 9 months. 9 months. 9 months means 31st December 2021 or 31st December 2022, whichever is later. Whichever is later means that is 31st December 2022. That means if SSC dies on 10th October 2020, if any compensation is received, the details relating to that compensation is required to be disclosed to the income tax officer on or before 31st December 2022. Are you able to understand? Information is required to be disclosed to the income tax officer within 9 months from the end of the financial year in which the SSC dies, or 31st December 2022, whichever is later. Have you understood? Is it clear? Next, family means what? Family in relation to individual means spouse and children of the individual, and parents, brothers and sisters of the individual, or any of them wholly or mainly dependent on the individual. In case of individual, who comes under family? First, his spouse, his or her spouse and children becomes family. Along with them, parents are also to be considered as family. Along with them, brothers and sisters who are mainly dependent on the individual, they will also be to be considered as family. So these are the amendments relating to income from other sources chapter. Next, amendments relating to chapter 6A deductions. Do you remember section 80DD? First of all, do you remember section 80U? In case if SSC suffers with disability, and such disability is normal disability, straight away flat 75,000 is allowed as deduction. If SSC suffers with severe disability, then straight away 1,25,000 is allowed as deduction to the SSC. Now, not the SSC. If any person who is dependent on the SSC, there is SSC Mr. X, his wife is Mrs. X, Mrs. X is suffering with disability. Now he cannot claim deduction under section 80U, he can claim deduction under section 80DD. That means if any person, like any person who is dependent on the SSC, if that person is suffering with disability, SSC can claim deduction under section 80DD. If dependent person is suffering with normal disability, SSC can claim deduction of 75,000. If dependent person is suffering with severe disability, SSC can claim deduction of 1,25,000. Are you able to understand? Do you remember these provisions which were discussed in the class? Now the thing is, SSC needs to prove that he is incurring medical expenditure. SSC needs to prove that he is incurring medical expenditure in relation to disability of the dependent, So there are two persons here. There is individual who is SSC. There is individual. Another person is dependent person suffering with disability. So there are two people here. Individual is there. Dependent on that individual, there is dependent person who is suffering with disability. Now, if SSC incurs any expenditure, in relation to dependent person who is suffering with disability, if such disability is normal disability, SSC can claim 75,000 as deduction. If such disability is severe disability, SSC can claim 1,25,000 as deduction. Are you able to understand? But SSC needs to prove to the income tax department that he is incurring medical expenditure. He need to show some proof. There are two cases here. SSC can either incur medical expenditure, or SSC can pay some insurance amount. in the name of the dependent disabled person. In these two ways, SSC can do. SSC can prove to the department. Are you able to understand? There are two ways. One way is SSC can incur medical expenditure. Another way is SSC is required to pay insurance amount in the name of the dependent person who is suffering with disability. Are you able to understand? Now, let's say there is Mr. A. His wife is Mrs. A, who is suffering with disability. In the name of Mrs. A, every month 5,000 rupees insurance is being paid by Mr. A. So that already Mrs. A is suffering with disability. If she gets hospitalized or if she dies, then like he is paying every month insurance premium, right? He will receive some lump sum amount. He will receive some lump sum amount, or his medical expenses of Mrs. A will be reimbursed by the insurance company. For this purpose, he is paying insurance premium to the insurance company. Are you able to understand? So two options are available. Either he can directly incur medical expenditure, or he can pay insurance premium to give effect that, to show that he is actually maintaining the disabled person. He is actually maintaining the disabled person, irrespective of the expenditure that is paid, irrespective of the insurance premium that is paid. If it is normal disability, 75,000 is allowed as deduction. If it is severe disability, 1,25,000 is allowed as deduction. Now he is paying insurance amount, right? He is paying insurance amount. One fine day he will receive maturity amount. He will receive maturity amount. We are going to discuss about tax treatment of the maturity amount. For that, I will draw one chart. After drawing the chart, you will be able to understand. Okay, note down. If maturity amount is received, maturity amount is received by dependent suffering with disability, dependent suffering with disability. If maturity amount is received by dependent suffering with disability, that means there are two people, right? Mr. A is SSC, dependent on him is Mrs. A. Mrs. A is dependent suffering with disability. Am I correct? Dependent suffering with, or we can write like this, dependent disabled person. Dependent disabled person. Now maturity amount is received by whom? Maturity amount is received by Mrs. A, dependent disabled person. Dependent suffering with disability. On death of the individual, or on attaining 60 years by that individual, on attaining 60 years by that individual, on attaining 60 years by that individual. In these two cases, whatever the maturity amount that is received by dependent, such maturity amount is exempt. Maturity amount is exempt in the hands of, maturity amount is exempt in the hands of dependent. Maturity amount is exempt in the hands of dependent. Maturity amount is exempt in the hands of dependent. So there is Mr. A who is SSC, there is Mrs. A who is dependent disabled person. Mr. A is every month paying insurance premium in the name of Mrs. A. Now Mrs. A is receiving maturity amount. When she is receiving maturity amount? Upon the death of Mr. A or after the retirement of Mr. A. That means after Mr. A attained 60 years. In these two events, on death of Mr. A or on attaining 60 years of Mr. A, Mrs. A is receiving maturity amount from the insurance company. Now whatever the maturity amount that is received by dependent disabled person, Mrs. A, such amount is not taxable in the hands of Mrs. A. Such amount is exempt in the hands of Mrs. A. So if ultimate maturity amount is received by dependent disabled person, in the hands of dependent disabled person, there is no taxability, there is exemption. Are you able to understand? Next. Maturity amount is received by individual upon the death of dependent person, upon the death of dependent person, suffering with disability, upon the death of dependent person suffering with disability. Maturity amount is taxable in the hands of individual. Maturity amount is taxable in the hands of individual. Maturity amount is taxable in the hands of individual. Maturity amount is taxable in the hands of individual. What do you mean by this? There is Mr. A and Mrs. A. Mrs. A is suffering with disability. She is dependent disabled person. Mrs. A died. Mrs. A died. Now maturity amount is received by Mr. A. Whatever the maturity amount that is received by Mr. A, it is taxable in the hands of Mr. A. That means upon the death of the dependent disabled person, if maturity amount is received by individual, such maturity amount is taxable in the hands of individual. Are you able to understand? Is it clear? Next. Amendment relating to section 80 CCD. Do you remember section 80 CCD? Central Government Pension Scheme or National Pension System Trust. Under section 80 CCD, benefit is available to both salaried employees and self-employees. Do you remember? No? Don't you? Konchama? Toda. Under section 80 CCD, the benefit is available to both salaried employees and self-employees. The benefit is available to both salaried employees and self-employees. For self-employees, how much deduction is allowed for self-employees? Up to 20% of gross total income is allowed as deduction. Up to 20% of gross total income is allowed as deduction in case of self-employees. In case of salaried employees, there will be two classifications: employer contribution and employee contribution. Employer contribution and employee contribution. How much employee contribution is allowed as deduction? Up to 10% of salary. Up to 10% of salary, employee contribution is allowed as deduction. Do you remember this chart? Sir would have given to you. Next, for employer contribution, there is another two classification. If employer is central government employer, up to 14% of salary will be allowed as deduction. Up to 14% of salary will be allowed as deduction. Any other employer means up to 10% of salary will only be allowed as deduction. Any other employer means only up to 10% of salary will only be allowed as deduction. So employer contribution, central government employer or state government employer. This is the amendment. Not only central government employer, in case of state government employer also, up to 14% of the salary will be allowed as deduction. This is the amendment. Have you understood? Under section 80 CCD, benefit is available to both salaried employees and self-employees. For salaried employees and self-employees, for employee contribution of salaried employee and self-employee, the benefit is allowed under section 80 CCD 1. For employer contribution, the benefit is allowed under section 80 CCD 2. For employer contribution, if it is central government employer, up to 14% of the salary will be allowed. Up to 14% of the salary will be allowed. Not only central government employer, if it is state government employer, then also up to 14% of the salary was allowed. Okay, it is allowed as deduction. This is the new amendment. Have you understood? Next, amendments relating to computation of total income and tax liability of individuals. Do you remember AMT, alternate minimum tax? In total income chapter, we have discussed alternate minimum tax. Alternate minimum tax is applicable only, like it is applicable for all SSCs other than companies. It is applicable when SSC claims any one of the three deductions. One is deduction under section 35 AD, deduction under section 10 AA special economic zone deduction, deductions under section 80 IA to 80 RRB. If any one of these deduction is claimed by the SSC, then alternate minimum tax gets attracted. What if alternate minimum tax gets attracted? If alternate minimum tax gets attracted, normal tax liability or alternate minimum tax, whichever is higher is required to be paid by the SSC. The rate of alternate minimum tax is 18.5%. The rate of alternate minimum tax is 18.5%. If AMT is applicable, we will calculate two tax liabilities. First, we will calculate regular tax liability. Then we will also calculate alternate minimum tax by applying 18.5% tax. In these two tax liabilities, whichever is higher is there, a higher tax liability is required to be paid to the government. Do you remember? Now, generally the AMT rate, alternate minimum tax rate, is 18.5%. However, in case of cooperative societies, the alternate minimum tax rate is reduced from 18.5% to 15%. Are you able to understand? In case of cooperative societies, alternate minimum tax is reduced from 18.5% to 15%. Generally, AMT rate applicable for all SSCs other than companies is 18.5%. However, specifically for cooperative society, alternate minimum tax rate is reduced from 18.5% to 15%. Are you able to understand? Now we are going to discuss about amendments relating to TDS and TCS chapter. Very important amendment, and the recent amendment which got introduced, it is section 194R. At the time, when we have started the chapter PGBP head, first we discussed about section 28. What are the incomes that are taxable under PGBP head? At that point of time, there is one point: any benefit or perquisite that is received during the course of business or profession, such benefit or perquisite is taxable under PGBP head. Do you remember that point? Any benefit or perquisite, generally if any benefit is received, it is taxable under income from other sources. However, if benefit is received out of business or profession, such benefit is taxable under the head PGBP. Do you remember? For example, let's take I went to Lalita Jewelry. I did audit of Lalita Jewelry. For example, I did audit of Lalita Jewelry. They have paid me audit fees of 10 lakh rupees. They got very much impressed with my audit. In addition to 10 lakhs, they gave me benefit of 1 lakh rupees. Generally, this 1 lakh rupees is gift to me. Generally, 1 lakh rupees of gift is to be taxable under the head income from other sources. There is no personal transaction in between Lalita Jewelry and me. Only transaction is audit. That means because of the audit, because they got impressed with audit, they gave additional benefit of 1 lakh rupees. This 1 lakh rupees is not taxable to me under the head income from other sources. This 1 lakh rupees is taxable to me under the head PGBP. So any perquisite or benefit that is received out of business or profession, such benefit or perquisite is taxable under PGBP head. Now the thing is, on payment of such benefit, TDS is required to be deducted under section 194R. Deduction of tax at source on benefit or perquisite in respect of business or profession under section 194R. This provision 194R came into force from 1st July 2022. What this says: any benefit or perquisite, whether convertible into money or not, arising from business or profession, generally this is taxable under PGBP head. On such amount, payer is required to deduct TDS. What is the threshold limit? Threshold limit is 20,000. That means if benefit paid is up to 20,000 rupees, no TDS is required to be deducted. If benefit paid is more than 20,000 rupees, then TDS is required to be deducted. Now Lalita Jewelry owner, that boss paid me 1 lakh rupees, right? Boss means what? Do you know Lalita Jewelry owner? He is to be called as boss. Now boss, he got very much impressed with my audit, along with payment of audit fees of 10 lakh rupees. In addition, he paid me benefit of 1 lakh rupees. This, how much benefit he paid? 1 lakh rupees, which is greater than threshold limit of 20,000 rupees. Now boss is required to deduct TDS. So payer must be any person, payee must be resident. What is the rate of TDS? 10% of value or aggregate of value of such benefit. Non-applicability of section 194R. When 194R is not applicable, in case of resident, where value or aggregate value of benefit or perquisite provided or likely to be provided to such resident during the financial year does not exceed 20,000. Simply nothing but threshold limit. If benefit given is up to 20,000 rupees, TDS provisions will not get attracted. If benefit given is more than 20,000, then TDS provisions gets attracted. Another one. In case of an individual or HUF whose total sales or gross receipts or turnover from business or profession does not exceed 1 crore in case of business or 50 lakhs in profession during the financial year immediately preceding the financial year in which such benefit or perquisite may be given. Simply, if benefit is paid by the payer, if payer is individual or HUF, whose turnover during preceding financial year is less than or equal to 1 crore, or whose gross receipts in profession during preceding financial year is less than or equal to 50 lakhs, then even though he makes payment of benefit of more than 20,000, still he is not required to deduct TDS. Are you able to understand? If payer's business turnover during preceding financial year is less than or equal to 1 crore, or if payer's gross receipts in profession is less than or equal to 50 lakhs, and if payer is individual or HUF, then even though he makes payment of benefit of more than 20,000, still he is not required to deduct TDS. No worries, I will explain this section 194R in 3 cases in chart very clearly. Note it down, you will get complete clarity. Amendments relating to TDS and TCS, right? Section 194R. Now, see, Lalita Jewelry can give me benefit in cash, or it can give me benefit in kind, or it can give me benefit partly in cash, partly in kind. Three possible cases can happen, right? In all these 3 possible cases, how TDS is required to be deducted, that we are going to discuss now. First case, case 1. If benefit is given in cash, if benefit is given in cash, so there is Mr. U, he did audit of Lalita Jewelry, After completion of audit fees was paid. Along with audit fees, benefit of 1 lakh rupees is given. By Lalita Jewelry to Mr. U. Benefit of rupees 1 lakh is given by Lalita Jewelry to Mr. U. What is the threshold limit? First of all, this benefit is taxable to Mr. U. Under PGBP head. Do you agree with me? Benefit is taxable to Mr. U under PGBP head. Do you agree with me? So how much benefit is being paid? Here benefit is cash benefit. How much benefit is being paid? 1 lakh rupees. What is the threshold limit? Threshold limit is 20,000. Whether benefit paid is greater than threshold limit or less than threshold limit? Benefit paid is greater than threshold limit. So how much is the benefit? Benefit is 1 lakh rupees. At the time of making payment of 1 lakh rupees, TDS under section 194R at the rate of 10% is required to be deducted. Less TDS at the rate of 10%. Under section 194R. 10% means 1 lakh into 10%, it will be 10,000. So how much is the balance? Balance is 90,000. This 10,000 is required to be paid to government by Lalita Jewelry. 10,000 is required to be paid to government by Lalita Jewelry, and only 90,000 will be paid to Mr. U. Are you able to understand? Is it clear? Although Lalita Jewelry is paying 1 lakh rupees benefit, 1 lakh rupees will not reach to Mr. U. 10% TDS will be deducted and only 90,000 will be paid to Mr. U. Whatever the TDS that is being deducted TDS is deposited to the government by Lalita Jewelry. Have you understood case 1? Is it clear? Is it crystal clear? I can't hear. Seems you are hungry. No? Then I can take till the completion of part 2. Shall I explain case 2? If benefit is wholly in kind, benefit is wholly in kind. Benefit is wholly in kind. Benefit is wholly in kind. So there is Mr. U. Again, there is Mr. U, and there is Lalita Jewelry. Mr. U conducted audit of Lalita Jewelry. This time, Lalita Jewelry paid audit fees of 10 lakh rupees to Mr. U. Lalita Jewelry paid audit fees of 10 lakh rupees to Mr. U. Now, after completion of audit, wife of Mr. U went to Lalita Jewelry. Wife of Mr. U, she took 10 grams worth of gold jewelry. When Lalita Jewelry people asked about amount payment, she said, my husband will come and he will pay the bill. So how many grams of gold did, like, wife of Mr. U took 10 grams of gold. When Mr. U went to Lalita Jewelry for payment of 10 grams gold worth of the bill, boss came and said, okay, you did audit fantastically, okay, the way you have done is superb, so you need not pay a bill regarding those 10 grams worth of gold, he said. Now, that benefit is received out of profession, right? That benefit was received out of profession. So Lalita Jewelry is indirectly paying to Mr. U. Although it was taken by wife of Mr. U, prima facie it is given to Mr. U only, right? So Lalita Jewelry gave 10 grams of gold. Lalita Jewelry gave 10 grams of gold to Mr. X. 10 grams of gold to Mr. X. Fair market value of 1 gram of gold. Fair market value of 1 gram of gold is equal to 5,000. Fair market value of 1 gram of gold is equal to 5,000 rupees. So what would be the fair market value of 10 grams of gold? Fair market value of 10 grams of gold will be 50,000. Now there are two alternatives. Alternative 1, alternative 2. Here the value of the benefit is greater than 20,000 or not? The value of the benefit is greater than 20,000. Actually, Lalita Jewelry is required to deduct TDS, but it cannot, from jewelry, it cannot take some piece and it cannot deposit to the government, right? It is illogical purely. So there are two alternatives we are going to see. Alternative 1, alternative 2. Under alternative 1, Lalita Jewelry can ask Mr. U to deposit 10% of tax with the government and to produce deposit certificate, advance tax certificate, on the basis of, like, if Mr. U produces 10% of the advance tax certificate, then Lalita Jewelry is not required to deduct TDS because already tax has been going to the government. Are you able to understand? So in alternative 1, Mr. U can deposit 10% of TDS to the government. That means Mr. U can deposit, what is the value? Value is 50,000, right? So how much will be the tax? Tax will be 50,000 into 10%, 5,000. Tax will be 50,000 into 10%, 5,000. Am I correct? So Mr. U can deposit 5,000 with the government and Mr. U can produce whatever the 5,000 payment challan is there. That 5,000 payment challan can be given to Lalita Jewelry. Now Lalita Jewelry is not required to deduct TDS because already 10% is paid to the government by Mr. U. This is case 1. Mr. U said he does not want to pay any TDS, like he does not want to pay any tax to the government. Now in this case, what is the benefit that is given by Lalita Jewelry? Benefit given is 50,000 rupees, right? Benefit given is 50,000 rupees. This benefit we have to consider at 90%. And we need to gross up the benefit. Because if Lalita Jewelry is paying TDS, first of all, Lalita Jewelry gave jewelry and Lalita Jewelry is also again paying TDS. That means even whatever the TDS that is being paid by Lalita Jewelry to Mr. U, even that is also to be considered as benefit, right? So Mr. U is receiving two benefits from Lalita Jewelry. First of all, he is receiving 10 grams worth of gold. He is also receiving TDS amount. Both of them are benefit to Mr. U. So that's why we need to gross up. What is the gross up benefit? How much is the gross up benefit? Gross up means we need to multiply. Like convert this into 100%. 50,000 divided by 90 into 100. How much gross up benefit is? 55,555. 55,555. On 55,555, TDS is required to be calculated. TDS at the rate of 10% under section 194R. 55,555 into 10%. How much? 5,555. This 5,555 is required to be deposited by Lalita Jewelry to the government. Are you able to understand? Now, what is the benefit that is received by Mr. What is the benefit that is received by Mr. U? First benefit is 50,000 worth of gold. Second benefit is 5,555 TDS. Total will be 55,555. In this 10% means 5,555. So exactly TDS was deposited, right? Exactly TDS was deposited. Have you understood? This is the reason why we have done gross up. This is the reason why we have done gross up. If we do not do gross up means, benefit will be 50,000. Benefit will be 50,000. Amount of TDS will be 50,000 into 10%, 5,000. So total benefit is 55,000. On this 55,000, what is the TDS? TDS 10% means 5,500. But what is the TDS that is paid? TDS paid is 5,000 rupees. TDS required to be paid is 5,500. There is mismatch, right? There is mismatch. However, here there is no mismatch. That is why we have done gross up. That's why we have done gross up. Have you understood why we did gross up? Did you understand second case? If benefit is wholly in kind form, there are two alternatives available. Either payee. Payee means who is receiving the benefit. He can deposit 10% TDS to the government and he can produce the challan. Upon producing the challan, Lalita Jewelry is not required to deduct TDS. Or alternative 2. Whatever the benefit that is given, it is to be considered as 90% and it needs to be gross up to 100%. On gross up amount, 10% TDS is required to be paid by Lalita Jewelry to the government. Are you able to understand? Lalita Jewelry to the government. Is it clear? Now, shall we see case 3? Is it interesting? Case 3. Benefit partly in cash and partly in kind. Benefit partly in cash and partly in kind. Benefit partly in cash and partly in kind. Again, there is Mr. U. There is Lalita Jewelry. There is Lalita Jewelry. Mr. U received 9 grams of gold. Mr. U received 9 grams of gold plus 3,000 in cash. Plus 3,000 in cash. Mr. U received 9 grams of gold plus 3,000 in cash. Fair market value of 1 gram of gold. Fair market value of 1 gram of gold is 5,000 rupees. What is the fair market value of 9 grams of gold? Fair market value of 9 grams of gold is 45,000. In this case, that means part of the benefit is given in the form of kind, part of the benefit is given in the form of cash. Is given in the form of cash. Here also two alternatives are available. Here also two alternatives are available. Two alternatives are available. Case 1. Case 1. What is the benefit? Mr. U can deposit 10% of TDS to the government. Mr. U can deposit 10% of TDS to the government. What is the benefit that is received? Benefit received is 48,000, right? Benefit received is 48,000. Mr. U can, like, how much will be the TDS amount? 48,000 into 10%, 4,800. 4,800. Mr. U can deposit. Mr. U can deposit 4,800 to government. Mr. U can deposit 4,800 to government and can produce payment challan to Lalita Jewelry. Payment challan to Lalita Jewelry. So that Lalita Jewelry is not required to deduct TDS. So that Lalita Jewelry is not required to deduct TDS. Lalita Jewelry is not required to deduct TDS. Lalita Jewelry is not required to deduct TDS. Have you understood? Alternative 2. What is the benefit that is given by Lalita Jewelry to Mr. U? 45,000 in the form of kind, 3,000 in the form of cash. Total benefit given is 48,000. Apart from giving this benefit, TDS is also to be deposited by Lalita Jewelry. That means we need to again gross up. Shall I explain alternative 2? Have you finished writing? Alternative 2, not case, alternative. Alternative 2. What is the benefit that is being received? Benefit paid by Lalita Jewelry to Mr. U is 48,000. This we need to consider it 90%, right? How much is gross up benefit? Gross up benefit 48,000 divided by 90 into 100. How much? 53,333. This is gross up benefit, right? This is gross up benefit. On gross up benefit, TDS at the rate of 10% is required to be deducted under section 194R. TDS at the rate of 10% under section 194R. How much? 53,333 into 10%. How much? 5,333. 5,333. TDS at the rate of 10% under section 194R is 5,333. Now, this 5,333 is required to be deposited to the government by Lalita Jewelry. So these are the three cases. Did you understand TDS, like TDS treatment under three cases, how TDS is required to be deducted? Is it clear? The important thing is TDS is required to be deducted only if the payer, if payer is, or we can draw one chart regarding this. Shall we draw spontaneously? Payer for section 194R. Payer for the purpose of section 194R. If payer is individual or HUF, if payer is individual or HUF, if payer is any other person, if payer is any other person, if payer is any other person, TDS is required to be deducted. 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 If payer is individual or HUF, we need to check his turnover. We need to check his turnover. In preceding financial year, if turnover in business is greater than or equal to 1 crore, turnover in preceding financial year is less than or equal to 1 crore, or in profession, gross receipts are less than or equal to 50 lakhs in profession, whether he is required to deduct TDS. In case of individual or HUF, in preceding financial year. If his turnover is less than or equal to 1 crore in profession, if his gross receipts is less than or equal to 50 lakhs, whether he is required to deduct TDS? No. No TDS is required to be deducted. Under section 194R. No TDS is required to be deducted under section 194R. Even benefit paid is more than 20,000. Even benefit paid is more than 20,000. Even benefit paid is more than rupees 20,000. Even benefit paid is more than rupees 20,000. In case of individual or HUF, in preceding financial year, if turnover is greater than 1 crore in business, if gross receipts are greater than 50 lakhs in profession, then TDS is required to be deducted. Have you understood payer definition for section 194R? Is it clear? Did you get clarity? We can convert any provision into chat under income tax. See, if you are able to simplify the provision as simpler as possible, that much understanding you will get over the provision, that much grip you will get over the provision. You will get conceptual clarity. So there were around 10 questions relating to section 194R. Then there is 194IA, 194P. Okay, go for lunch. Remaining we will see post lunch. Okay. Try to assemble here by 2 o'clock. Now, we are going to discuss the questions that are there for section 194R. First question, is it necessary that person providing benefit or perquisite needs to check if the amount is taxable under section 28(4) before deducting tax under section 194R? In Lalita Jewelry example, there is no requirement on part of the Lalita Jewelry to check whether benefit is taxable to me under the head PGBP or not. Okay, first of all, it is providing benefit to me. When it is providing benefit to me and the value of the benefit is greater than 20,000, it is mandatorily required to deduct TDS. There is no such requirement on part of the payer to check whether income is taxable under PGBP head or not to the payee. Is it clear? Next. Is it necessary that benefit or perquisite must be in kind? Is it necessary? The benefit may be in cash, the benefit may be in kind, the benefit may be partly in cash or partly in kind. There is no such rule that benefit should mandatorily be in kind. Question 3. Is there any requirement to deduct TDS under section 194R when the benefit or perquisite is in the form of capital asset? There is no such rule that whatever the benefit that is given, it should be capital asset. Even the benefit given is not a capital asset, still TDS is required to be deducted. For example, client after performing audit, he paid me audit fees. Along with audit fees, he gave me iPhone 13 Pro Max, he gave me or iPhone 14 Pro Max. That means it is a benefit that is being received to me. The benefit is taxable under PGBP head. The value of the benefit is greater than 20,000. iPhone is not a capital asset, right? It is not a capital asset. It is excluded from definition of capital asset. Okay, iPhone is not a capital asset. Now, even though iPhone is not a capital asset, it is a benefit that is being given. On iPhone benefit that is given also, TDS is required to be deducted. So there is no such rule that whatever the benefit that is given in kind form, it should be a capital asset. No, even benefit is not a capital asset, still TDS is required to be deducted under section 194R. Are you able to understand? Next. Question 4. If loan settlement or waiver by a bank is to be treated as benefit or perquisite, it would lead to hardship as the bank would need to incur additional cost of tax deduction in addition to haircut that he has taken. Will section 194R apply in such a situation? I will explain this with a small example. There is Mr. U. there is Mr. U, there is HDFC Bank, there is HDFC Bank. Mr. U borrowed from HDFC Bank loan of rupees 1 crore. Mr. U borrowed loan of rupees 1 crore from HDFC Bank. See, Mr. U borrowed 1 crore rupees from HDFC Bank. Mr. U repaid 20 lakh rupees. Mr. U repaid 20 lakh rupees. Mr. U repaid 20 lakh rupees. Balance 80 lakhs, Mr. U is not at all repaying. Balance 80 lakh rupees, Mr. U is not at all repaying. Years passed, even though Mr. U is not at all repaying. Now, banker came with compromise with Mr. U. Banker came to compromise with Mr. U. Banker said that you took loan of rupees 1 crore from me, you repaid me 20 lakh rupees. Balance 80 lakhs you need to repay. Balance 80 lakhs you need to repay. However, years passed and you are not repaying me 80 lakh rupees. Banker said that please don't pay 80 lakh rupees. It is sufficient. Please pay 60 lakh rupees only. Please pay 60 lakh rupees only. Banker said. That means banker, he is reducing his balance that which he needs to recover from the SSC. Actually, banker has right to receive 80 lakh rupees from the SSC. But what banker is saying, you need not pay 80 lakh rupees. It is sufficient if you pay me 60 lakh rupees, banker is saying. That means 20 lakh rupees is benefit to the SSC, right? Whether it is benefit or not, it is benefit to the SSC. That benefit is taxable under PGBP head. Are you able to understand? Now, banker asked Mr. U to repay only rupees 60 lakhs. Only rupees 60 lakhs. Now, what is the benefit that is received by Mr. U? Benefit received by Mr. U is how much? Benefit received by Mr. U is how much? Benefit received by Mr. U is, actually he needs to repay 80 lakh rupees, but he is repaying only 60 lakh rupees. 80 lakhs minus 60 lakh rupees. What is the benefit that is received? Benefit that is received by Mr. U is 20 lakh rupees. This benefit is taxable under PGBP head as perquisite. Taxable under PGBP head as perquisite. If it is perquisite, TDS is required to be deducted, right? TDS is required to be deducted. Only in this case, TDS is not required to be deducted under section 194R. This case is specifically excluded. Already banker is losing 20 lakh rupees. In addition, if he is asked to deduct TDS, means from where he can get money, he cannot get money, right? That's why this case is specifically excluded from section 194R. That means in this case, even though there is benefit, still TDS is not required to be deducted under section 194R. Are you able to understand? Taxable under PGBP head as perquisite, but no TDS is required to be deducted. No TDS is required to be deducted under section 194R. No TDS is required to be deducted under section 194R. Is it clear? Actually, here also there is a benefit. Here also there is a benefit. On that benefit, TDS is required to be deducted. But this case is specifically, exclusively excluded from deduction under section 194R. In this case, TDS is not required to be deducted. Have you understood? Have you understood? Now read, the amount representing principal loan waived by the bank under one-time settlement scheme would constitute income falling under section 28(4), nothing but income taxable under PGBP head, relating to value of any benefit or perquisite arising from business or exercise of profession. However, it has been clarified that one-time loan settlement with borrowers or waiver of loan granted on reaching settlement with borrowers by following would not be subject to TDS under section 194R. This clarification is only for the purpose of section 194R. The treatment of such settlement or waiver in the hands of the person who had got benefited by such waiver would not be impacted by this clarification. Taxability, that means what? Here, the only thing that is excluded is he is not required to deduct TDS. However, whatever the benefit that is received, it is taxable under PGBP head only. Exemption is given only for non-deduction of TDS. Okay. However, income is not exempted. Income is taxable under PGBP head. Benefit received is taxable under PGBP head. Exemption is only given for deduction of TDS. TDS is not required to be deducted. However, exemption was not given to taxability of income. Whatever the benefit that is received, it is taxable under PGBP head only. Are you able to understand? Next, question 5. how is the valuation of benefit? How is the valuation of benefit or perquisite required to be carried out? In second case, I received 10 grams of gold from Lalita Jewelry. I received 10 grams of gold from Lalita Jewelry. If 10 grams of gold were purchased by Lalita Jewelry, whatever the purchase price that is paid by Lalita Jewelry, that is to be considered as value of the benefit. If 10 grams gold is not purchased by Lalita Jewelry, if it is manufactured by Lalita Jewelry, at what price Lalita Jewelry sells to its outside customers, that price is to be considered as value of the benefit. Here we need to consider, see, we have considered value of the benefit as 50,000, right? How to consider value of the benefit? If the whatever the benefit that is given by Lalita Jewelry, if it is purchased by it, whatever the purchase price that it pays, purchase price is to be considered as value of the benefit. If the benefit is manufactured by Lalita Jewelry, then whatever the price at which it is selling it to its outside customers, nothing but selling price, that selling price is to be considered as value of the benefit. Now read. Situation value. The benefit or perquisite provided has purchased the benefit or perquisite before providing it to the recipient. Then what is the value? Value will be purchase price. The benefit or perquisite provider manufactures such items given as benefit or perquisite. In such a case, price that it charges to its customers for such items, nothing but selling price is to be considered as value of the benefit. Have you understood? And only taxable value you need to consider. At the time of calculation of the value of the benefit, you need to consider only taxable value. You should not consider GST. For example, value of the benefit is 50,000. GST is 5,000 rupees. Invoice value is 55,000. Now, how much you will consider as value of the benefit? Value of the benefit you will consider as 50,000 only, not 55,000. Are you able to understand? GST, you should not consider it as value of the benefit. Question 6. Many times a social media influencer is given a product of a manufacturing company so that he can use the product and make audio or video to speak about that product in social media. Is that product given to such influencer a benefit or perquisite? I'll tell you. Let's say tomorrow Apple is going to launch iPhone 15 Pro Max. It is going to launch, for example, iPhone 15 Pro Max. Now, before launching iPhone 15 Pro Max, there is one YouTuber. He has 10 million followers. So iPhone 15 Pro Max approached that YouTuber. iPhone 15 Pro Max has given its one piece of iPhone 15 Pro Max to the YouTuber and asked YouTuber to explain about iPhone 15 Pro Max in his channel. Now, this YouTuber, he explained about iPhone 15 Pro Max, everything. The video was very good and the content is delivered. After preparation of the content for the YouTube video, the iPhone 15 Pro Max is again given by the YouTuber to the Apple company. In this case, there is no benefit that is received by YouTuber, right? If there is no benefit received, there is no concept of TDS. However, after completion of the content, after creating the video also, if an iPhone 15 Pro Max retains with the YouTuber, if iPhone 15 Pro Max is with the YouTuber, then some benefit would have been received by the YouTuber. On such benefit, Apple is required to deduct TDS under section 194R. Are you able to understand? Now read this sentence, you will understand. Whether this benefit or perquisite will depends upon the facts of the case. In case of benefit or perquisite being a product like car, mobile, outfit, cosmetics, etc., and if the product is returned to the manufacturing company, after using for the purpose of rendering service, then it will not be treated as benefit or perquisite for the purpose of section 194R. That means if it is returned, no benefit is received. If no benefit is received, no TDS is required to be deducted under section 194R. If the product that is received, if it is not returned, then benefit would have been received. On such benefit, TDS is required to be deducted. However, if the product is retained means what? It will be retained with the YouTuber or social media person. It would be in the nature of benefit or perquisite and tax is required to be deducted accordingly under section 194R. Is it clear? Next question number 7. Section 194R provides that if benefit or perquisite is in kind or partly in kind and cash is not sufficient to meet TDS, then person responsible for providing such benefit or perquisite is required to ensure that tax is required to be deducted has been paid in respect of the benefit or perquisite before releasing the benefit or perquisite. How can such person be satisfied that tax has been deposited? Simple. And in entire question number 7, one point is very important. Please underline it. What this point says is TDS is required to be deducted not only on the benefit amount, whatever the TDS amount that is paid, it is also to be considered as benefit, right? So TDS is required to be deducted on benefit plus TDS amount. That's why we have done gross up at the time of calculation. Are you able to understand? Next. Question 8. Company A gifts car to its dealer B and deducted tax on this benefit under section 194R. Dealer B uses this car in his business. Will he get deduction for depreciation in calculating his income under the head PGBP? What do you mean by this? This is relating to question number 8. There is company A. Company A gifted car to its dealer B, Now, from B point of view, what is the entry that dealer will write? See, there is a company, car company, and there is car dealer. There is a car dealer. Car dealer is receiving benefit of car from the car company. Now, this is benefit, right? Benefit is taxable to him under the head PGBP. What is the entry that dealer B will write? For example, if the car value is, let's say, 10 lakh rupees or car value is 9 lakh rupees, what is the entry that he will pass? Car account debit 9 lakh rupees to P&L account. This is the entry that he will pass, right? Car account debit to P&L account 9 lakh rupees that he will pass. That means 9 lakh rupees it is taxable under PGBP head. Whatever the car, that means to fixed assets account 9 lakh rupees was debited. Car account 9 lakh rupees was debited. This 9 lakhs is eligible for depreciation because it is capitalized. It will be classified as fixed assets. Once it is classified as fixed asset, it is eligible for depreciation under section 32. Even though no cash is paid, but the amount is getting taxed under PGBP head. That's why 9 lakhs is also eligible for depreciation. Are you able to understand? Is eligible for depreciation. Is it clear? Have you understood? Next, CRD 9. Section 194R would come into effect from 1st July 2022. It provides that the provision of this section does not apply where value or aggregate of value of the benefit or perquisite provided or likely to be provided to a resident during the financial year does not exceed 20,000 rupees. Is it not clear how this limit of 20,000 is to be computed for financial year 22-23? What do you mean by this? Previous year 22-23. What is the range for previous year 20-23? 1st April 2022 to 31st March 2023. Antena 1st April 2022 to 31st March 2023. 194R is applicable. 194R is applicable from 1st July 2022. From 1st July 2022, 194R is applicable. 194R is applicable. That means if any benefit is provided after 1st July 2022, then TDS is required to be deducted. Now, during this period, 40,000 benefit was received. 40,000 benefit was paid. Whether TDS is required to be deducted? From 1st April 2022 to up to 1st July 2022, up to 30th June 2022, 40,000 benefit is paid. Whether TDS is required to be deducted or TDS is not required to be deducted. TDS is not required to be deducted because TDS section came into force from 1st July 2022. In this case, no TDS is required to be deducted. Because during when 40,000 benefit is paid, 194R section is not at all there. So no TDS is required to be deducted. If benefit is paid at this point of time, then TDS is required to be deducted. However, for calculating threshold limit of 20,000 rupees, even benefit provided during 1st April 2022 to 30th June 2022 is also required to be considered. Are you able to understand? What do you mean by this? See, during this period, 5,000 benefit was provided. Whether TDS is required to be deducted or TDS is not required to be deducted. TDS is required to be deducted because for computing threshold limit, whatever the benefit that is provided from 1st April 2022 onwards, it is required to be considered. From 1st April 2022 to 30th June 2022, already 40,000 benefit was provided, which is greater than threshold limit of 20,000 rupees. So on this 5,000 also TDS is required to be deducted. TDS is required to be deducted under section 194R. Have you understood? Generally, if any benefit is provided from 1st April 2022 to 30th June 2022, on such benefit no TDS is required to be deducted. Whatever the benefit that is provided from 1st July 2022, only on such benefit TDS is required to be deducted. However, at the time of calculating threshold limit of 20,000 rupees, whatever the benefit that is provided from 1st April 2022 to 30th June 2022, even such benefit is also to be considered at the time of calculating threshold limit of 20,000 rupees. Are you able to understand? So now here we can write no TDS is required to be deducted, but to calculate threshold limit of 20,000 rupees, 40,000 is required to be considered. Have you understood? If any benefit or perquisite is provided from 1st April 2022 to 30th June 2022, on such benefit no TDS is required to be deducted. Only if the benefit is provided on or after 1st July 2022, then only TDS is required to be deducted. In order to deduct TDS or not, for that you need to check threshold limit. At the time of checking of threshold limit of 20,000 rupees, whatever the benefit that is provided from 1st April 2022 to 30th June 2022, even such benefit is also required to be considered at the time of calculating threshold limit. Is it clear? Question 10. Whether issuance of bonus shares or right shares is a benefit or perquisite if issued by a company in which public are substantially interested, and whether tax is required to be deducted under section 194R. See, for existing shareholders, bonus shares and right shares will be issued, right? Giving bonus shares is also a benefit. Giving right shares is also a benefit because right shares are always issued at some discounted price, more than market price. So, by way of issue of right shares also, by way of issue of bonus shares also, shareholders will be receiving certain benefit. However, on this benefit, no TDS is required to be deducted under section 194R. Are you able to understand? With this, we have finished section 194R. Do you remember section 206C1G? I don't think so. That's why I'm here to explain to you. 206C1G. Remittance made outside India. Threshold limit is 7 lakh rupees. If more than 7 lakh rupees is remitted outside India, then TCS provisions will be applicable. 206C1G. Do you remember this concept? TCS on overseas remittance, or an overseas tour program package. Threshold limit is 7 lakh rupees. Rate of TCS is 5%. What do you mean by this? Let's say there is your friend. He is studying in Harvard University. For his study over there, fees is required to be paid. Let's say fees amount is 60 lakh rupees. Now what your friend's parents will do? They will go to authorized dealer. Or the authorized dealer means what? He will convert Indian rupees into foreign dollars, American dollars, and he pays American dollars to that particular university. The middleman is called as authorized dealer. Now, how much amount they are remitting outside India? They are remitting outside India 60 lakh rupees. How much is remittance? Remittance is 60 lakh rupees. What is the threshold limit? Threshold limit is only 7 lakhs. Well, here remittance is more than threshold limit. Remittance is more than threshold limit. Now authorized dealer along with 60 lakh rupees, he will also collect TCS at the rate of 5%. He will also collect TCS at the rate of 5%. TCS at the rate of 5% means 60 lakh into 5%, it will be 3 lakhs, right? So he will also collect 3 lakh rupees. In total it will be 63 lakh rupees. In total it will be 63 lakh rupees. Are you able to understand? In total it will be 63 lakh rupees. 3 lakh rupees will be paid to government. 3 lakh rupees will be paid to government. The 60 lakhs will be remitted outside India. The 60 lakhs will be remitted outside India. Did you understand this concept? So, if any Indian person is making remittance outside India, threshold limit is 7 lakh rupees. If outside India remittance is up to 7 lakh rupees, no TCS will be applicable. TCS provisions are not applicable. If outside India more than 7 lakhs are being remitted, then authorized dealer along with remittance amount, he will also collect additionally TCS at the rate of 5%. TCS at the rate of 5%. This is all about section 206C. 1G. This is all about section 206C 1G. Till now I did not explain any new thing. Whatever that is explained in your class, that's what only I have explained. Now I will teach you the amendment. The amendment is, the central government has vide notification number 99/2022 dated 17th August 2022 notified that the provisions of section 206C 1G would not be applicable to a person being a buyer who is a non-resident in terms of section C and does not have permanent establishment in India. See, there are two conditions. First condition is SSE must be non-resident. Second condition should be he should not have permanent establishment in India. See, in case of a non-resident who comes to India and if he does not have any permanent establishment in India, two conditions are satisfied. Even if he makes remittance of more than 7 lakhs outside India, still no TCS is collected. TCS provisions are not applicable. There are two conditions. What are those two conditions? First condition is SSE must be non-resident. Second condition, SSE should not have permanent establishment in India. If these two conditions are satisfied, then even though SSE makes remittance of more than 7 lakh rupees outside India, still TCS provisions are not applicable. Is it clear? That is the amendment. Nothing but exception. Section 206C1G is not applicable if two conditions are satisfied. If SSE is non-resident and SSE does not have permanent establishment in India. If these two conditions are satisfied, then for that SSE, section 206C1G is not applicable. Is it clear? You will get the doubt, sir, what permanent establishment means. In your CA final, you are going to study about what permanent establishment means. There is a separate segment called international taxation, in that international taxation you will come to know what permanent establishment means. Okay, at CA inter level you do not have this concept. Next, section 194 IA. Like in class, sir would have explained to you or I have explained to you. If the buyer is buying immovable property from the seller, and if the value of the property is greater than 50 lakhs, then buyer is required to deduct TDS at the rate of 1% under section 194 IA. Do you remember? For you only. I am ready with even TDS chapter also. Not to make you trouble. See 194 IA. When this is applicable, payment on transfer of immovable property. Threshold limit is up to 50 lakhs, less than 50 lakhs. What is the rate of TDS? 1% of such sum or the stamp duty value of the property, whichever is higher. Now, I can explain this simply using one small example. Section 194 IA. There are two parties. One is seller, another one is buyer. There is a transaction in between seller and buyer. If value of the transaction is less than 50 lakhs, value of the transaction is less than 50 lakhs, no TDS is required to be deducted. If value is greater than or equal to 50 lakhs, buyer is required to deduct TDS. Buyer is required to deduct TDS at the rate of 1%. Buyer is required to deduct TDS at the rate of 1%. Now, what do you mean by this value? This value you have to consider as stamp duty value or actual consideration, whichever is higher. Stamp duty value or actual consideration, whichever is higher. That means if result is less than 50 lakhs, no TDS, there will be no TDS. If result is greater than or equal to 50 lakhs, then TDS at the rate of 1% is required to be deducted on stamp duty value or actual consideration, whichever is higher. Is it clear? First you need to take stamp duty value, you need to take actual consideration. In these two, whichever is higher you need to take. That you need to compare with threshold limit of 50 lakhs. Whichever is higher is, if it is less than 50 lakhs, no TDS is required to be deducted. If out of these two, whichever is higher amount you will arrive, right? That higher amount, if it is greater than or equal to 50 lakhs, then TDS is required to be deducted at the rate of 1% on stamp duty value or actual consideration, whichever is higher. Are you able to understand? Now, let me give you a small example so that you will understand it much better. There is seller, there is also buyer. There is immovable property transaction. Stamp duty value is equal to 40 lakhs. Actual consideration is equal to 55 lakhs. Now, whether TDS is required to be deducted under section 194IA or not. First, you need to check threshold limit. What is the formula to check threshold limit? First, you need to consider stamp duty value or actual consideration, whichever is higher. Stamp duty value is 40 lakhs or 55 lakhs. 55 lakhs. Whichever is higher means 55 lakhs, right? So higher amount is 55 lakhs. Higher amount is 55 lakhs. You need to compare higher amount. With threshold limit. How much is threshold limit? Threshold limit is 50 lakhs. What is the equation? Higher amount is greater than threshold limit. Whether TDS is required to be deducted or TDS is not required to be deducted. TDS is required to be deducted. TDS at the rate of 1% on stamp duty value or actual consideration, whichever is higher. So TDS at the rate of 1% on 40 lakhs or 55 lakhs, whichever is higher. Means 55 lakhs. So on 55 lakhs, TDS is required to be deducted. So TDS is equal to 55 lakhs into 1%. 55 lakhs into 1%. How much? TDS amount is 55,000. Are you able to understand? So first you need to check threshold limit. At the time of checking threshold limit also, whichever is higher you need to take. Stamp duty value or actual consideration, whichever is higher you need to take. That higher amount you need to compare with threshold limit of 50 lakhs. Okay, if result income is less than 50 lakhs, no TDS is required to be deducted. If resultant is greater than or equal to 50 lakhs, then TDS is required to be deducted. On how much amount TDS is required to be deducted? TDS at the rate of 1% is required to be deducted on stamp duty value or actual consideration, whichever is higher. Is it clear? So have you understood section 194IA? Is it clear? But there is exception. Transfer of rural agricultural land. On transfer of rural agricultural land, TDS under section 194IA will not get attracted because rural agricultural land is not a capital asset. On transfer of rural agricultural land, there will be no capital gains. So consequently, TDS is also not required to be deducted under section 194IA. Is it clear? Next, do you remember section 194P? Anyone of you? Section 194P. Yeah, specified senior citizen. Who is called as specified senior citizen? Who is greater than 75 years of age, right? Actually, this concept was already discussed in class in TDS chapter. See, 194p specified senior citizen concept is there. This we have already discussed. Here it was given specified senior citizen means who is having above 75 years of age. Who is of the age 75 years or more at any time during the previous year. Now, what this section says, in case of specified senior citizen, he should have only two incomes. One income is pension income, in the bank account to which pension gets credited. From such bank account he is receiving interest income. SSC should have only these two incomes. Okay, first one is pension income, second one is to the bank account in which pension gets credited, he should have interest income. If the SSC has these two incomes, then SSC, like specified senior citizen who is of 75 years or more, he is not required to file his income tax return. He will go to the bank manager, and he will tell to the bank manager that he has only these two incomes. One is pension income and another one is like the bank account in which pension gets created, he will have interest income. Then what bank manager will do? Bank manager will calculate total income of specified senior citizen. He will also consider chapter 6A deductions of specified senior citizen. Then bank manager will arrive at the tax liability of specified senior citizen. After arriving at the tax liability of specified senior citizen by the bank manager, from whatever the amount that is there in his bank account, he will reduce TDS under section 194p. Whatever the tax liability of specified senior citizen is there, the tax liability is reduced in the form of TDS under section 194p by the bank manager. That means the tax liability of the specified senior citizen is discharged by the bank manager in the form of TDS. Now, whatever the tax liability that is to be received from specified senior citizen, it already reached to the government, right? Now specified senior citizen is again not required to file any income tax return. Are you able to understand? So actually his age is 75 years or more, he cannot file his income tax return, right? So specifically he is exempted from filing income tax return. Whatever the tax that is required to be collected from specified senior citizen, it is to be collected from the bank manager under section 194p in the form of TDS. Are you able to understand? Is it clear? In the provision, it was said that the bank should be a specified bank. What do you mean by specified bank? Banking company as notified by central government. There is no clarity with regard to specified bank means that is given earlier. However, through amendment, they have given clarity. Specified bank means a banking company which is a scheduled bank and has been appointed as agents of RBI under section 45 of RBI Act 1934. When you call a bank as specified bank, in order to call a bank as specified bank, two conditions are required to be satisfied. First of all, that bank should be scheduled bank. Second thing is, it should be appointed as agent of RBI. If these two conditions are satisfied, then that bank is called as specified bank. Only specified bank is eligible for deduction TDS under section 194p. That means only specified banks can deduct TDS under section 194p. Is it clear? When you call a bank as specified bank, if two conditions are satisfied, first condition is it must be a scheduled bank, and second condition is it should be appointed as agent of RBI. Only if these two conditions are satisfied, then only you will call that bank as specified bank, and specified bank is eligible to deduct TDS under section 194p. Is it clear? Next, higher rate of TDS or TCS for non-filers of income tax return. Those who do not file income tax return, for them higher rate of TDS or TCS provisions are applicable. Before I explain you this section, first let me explain you who is called as specified person. A person who has not furnished return of income for assessment year relevant to the previous year immediately preceding the financial year in which tax is required to be collected, for which the time limit for furnishing return of income under section 139(1) has expired, and aggregate of tax deducted at source and tax collected at source in his case is 50,000 or more in the said previous year. You will not understand like this. Definitely I need to draw a chart, then only you will understand. See, what is current previous year? What is current previous year? Current previous year is 22-23. Am I correct? Current previous year is 22-23. So this preceding financial year means preceding financial year is previous year 21-22. Preceding financial year is previous year 21-22. For previous year 21-22, what is the previous year 21-22 return of income is required to be furnished. Return of income is required to be furnished. Return of income is required to be furnished. For previous year 21-22, what is the assessment year? For previous year 21-22, assessment year is assessment year 22-23. For previous year 21-22, for previous year 21-22, when on or before which date return of income is required to be furnished? For example, for him no audit is applicable. For him no audit is applicable. On or before which date return of income is required to be furnished? For SSE, income tax audit is not applicable. Income tax audit is not applicable. What is the last date to file his income tax return for previous year 21-22? Last date to file income tax return is 31st July of the assessment year, right? 31st July 2022. 31st July 2022 is the last date. 31st July 2022 is the last date. If he files his income tax return within the due date, he will not be called as specified person. You will call him as specified person if he does not file his income tax return within the due date. That means if he files his income tax return, in this period, he will be called as specified person. Is it clear? First of all, you are required to deduct TDS or collect TDS in current previous year. Okay, then you need to go to the preceding financial year. Whether return of income for preceding financial year is filed within the due date or not, you have to check. If it is filed within the due date, he will not be called as specified person. If it is not filed within the due date, he will be called as specified person. Current previous year 2023, preceding financial year is previous year 21-22. What is in order to file income tax return for previous year 21-22, what is the due date? Due date is 31st July of the assessment year, 31st July 2022. If return of income is filed within the due date, he will not be called as specified person. If return of income is filed after the due date, he will be called as specified person. What if specified person? If an individual becomes specified person, and if TDS or TCS, is greater than 50,000, if TDS or TCS is greater than 50,000, if TDS or TCS is greater than 50,000, greater than or equal to 50,000, comma, then section 206AB, section 206CA are applicable. Then section 206AB, section 206CA are applicable. Have you understood? I didn't explain about section 206AB, 206CA yet. I am just explaining when they are applicable. Did you understand who will be called as specified person? Those person who do not file his income tax return on or before the due date, he will be called as specified person. In case of specified person, and if the amount of TDS or TCS is greater than 50,000, then section 206AB or section 206CA are applicable. Is it clear? What if this sections are applicable? What if these sections are applicable? If section 206AB is applicable, then TDS is required to be deducted at twice the rate that is specified in the Act, or twice the rate that is specified in the Finance Act, or 5%, whichever is higher. Are you able to understand? That means rate of TDS applicable or 5%, whichever is higher. In case of 194IA, rate of TDS is 1%. Twice the rate of TDS means 2% or 5%. Whichever is higher means 5%. 5% TDS is required to be deducted in case of specified person and amount of TDS or TCS is greater than 50,000. Are you able to understand? Is it clear? So twice the rate specified in the Act or 5%, whichever is higher. This is the amount. At this rate you need to deduct TDS. Is it clear? However, section 206AB is not applicable in case of tax deductible at source under section 192, 192A. 192D is relating to salaries. 192A is premature withdrawal from Provident Fund. 194B is winning from lotteries other than horse races. 194BB is winning from horse races. 194IA, just now we have discussed. At the time of purchase of immovable property, if more than 50 lakhs consideration is paid, TDS is required to be deducted. 194IB, payment of rent of more than 50,000 per month. In such a case also 206AB is not applicable. 194M what? In a cases where 194C, 194J, 194H are not applicable. Okay, 194C, for whom 194C, 194J, 194H are not applicable? In case of an individual or HUF whose turnover during preceding financial year is less than or equal to 1 crore, or whose gross receipts in profession during preceding financial year is less than or equal to 50 lakhs. They are not required to deduct TDS under section 194C, 194J, 194H. For these three people, if they are paying amount of more than 50 lakhs, then they are required to deduct TDS under section 194M. Under 194M also, section 206AB is not applicable. The only reason is, for all these sections, the rate of TDS is greater than 5%. That's why section 206AB is not applicable. If rate of TDS is more than 5%, then that particular rate of TDS is applicable, right? That's why they are covered under exceptions. Is it clear? 194N, cash withdrawal. Do you remember? If more than 1 crore cash is withdrawn on amount which is more than 1 crore, 2% TDS is deducted. Do you remember? So in all these sections, section 206AB is not applicable. Next, what if section 206CA is applicable? If section 206CA is applicable, then section 206CA speaks about TCS. Then twice the rate of TCS or 5%, whichever is higher, is required to be collected as TCS. Is it clear? At the time of collecting TCS, if section 206CA is applicable, then twice the rate of TCS or 5%, whichever is higher, you need to collect as TCS. Is it clear? See, on sale of car, 1% TCS is collected. 1% TCS is collected. However, if the buyer is covered under section 206CA, twice the rate of TCS means what? 1% into 2% or 5%, whichever is higher. 5% TCS is required to be collected. Is it clear? Have you understood? Did you understand when section 206CAB or section 206CA is applicable? If they are applicable, simple. Twice the rate as specified in the Act or 5%, whichever is higher. TDS is required to be deducted or TCS is required to be collected. Is it clear now? Have you understood? Do you have any doubt? You have understood, right? Next, we came to the last. Do you remember section 206C1F? No, sir. 206C1F. On sale of car, TCS is required to be collected at the rate of 1%. Do you remember? Okay, I will tell. There is seller of car. There is also buyer of car. Buyer is purchasing Fortuner from seller. Buyer is purchasing Fortuner from seller. Value of the car. If the value of car is up to rupees 10 lakhs. Value of car is up to rupees 10 lakhs. There will be no TCS. There will be no TCS. Value of the car is greater than 10 lakhs. Value of the car is greater than 10 lakhs. Then TCS at the rate of 1% is applicable. TCS at the rate of 1% is applicable. For example, if Fortuner car is, if car value is, let's say 45 lakh rupees, car value is 45 lakh rupees. Now seller, apart from collecting 45 lakh rupees, he will also additionally collect TCS at the rate of 1%. He will also additionally collect TCS at the rate of 1%. So to this we will add TCS at the rate of 1%. At the rate of 1% means 45 lakh into 1%. How much? 45,000, right? So seller will collect 45 lakh 45,000. Seller will collect 45 lakh 45,000 from buyer. So buyer need to pay 45 lakh 45,000 to the seller. Out of this 45 lakh 45,000, 45 lakhs will be recorded as sales. Nothing but revenue to the seller, right? This 45,000 is paid to the government. Have you understood? So on sale of car whose value is more than 10 lakhs, seller will collect TCS at the rate of 1%. If value of the car is up to rupees 10 lakhs, no TCS is required to be collected. If value of car is greater than 10 lakhs, then seller need to collect TCS at the rate of 1%. Seller is required to collect TCS at the rate of 1%. This is the provision relating to section 206C 1F. One more thing is, there is manufacturer, there is wholesaler, there is distributor, there is retailer, there is customer. On sale of cars by manufacturer to wholesaler, wholesaler to distributor, distributor to retailer, retailer to customer. Okay, in all these cases, in these three cases, section 206C 1F is not applicable. Section 206C 1F is not applicable. Section 206C 1F is applicable only on ultimate sale by retailer to customer. Only on ultimate sale by retailer to customer, section 206C 1F is applicable. Section 206C 1F is applicable. Have you understood? Section 206C 1F is applicable. Is it clear? Section 206C 1F is not applicable if manufacturer sells cars to distributor, if wholesaler, if wholesaler sells cars to distributor, if distributor sells cars to retailer. In all these transactions, section 206C 1F is not applicable. That means these people are not required to collect TCS. These people are not required to collect TCS on those transactions. However, at the time of sale by retailer to ultimate customer, then section 206C 1F is applicable and TCS is required to be collected. Have you understood? This is the provision relating to section 206C 1F. This is the provision relating to section 206C 1F. Now, shall I explain section 206C 1H? Shall I explain? Once if I give clarity about, if I revise section 206C 1F and section 206C 1H, then you will get some clarity. You will remember. At the time I can explain amendments. Now itself if I explain amendments means you will not understand at all. Shall I explain section 206C 1H? Section 206C 1H. There will be seller. Is this color visible properly? There will be seller, there will also be buyer. The condition is turnover during preceding financial year for seller should be greater than 10 crores. Turnover during preceding financial year for seller should be greater than 10 crores. And seller should sell goods greater than 50 lakhs to the buyer. Seller should sell goods greater than 50 lakhs to the buyer. At the time, seller along with 50 lakh rupees, he will also collect TCS at the rate of 0.1% in excess of 50 lakh rupees. Let's say sellers sold 80 lakh worth of goods to buyer. Seller sold 80 lakh worth of goods to buyer. Now, how much seller will collect amount? What is the taxable value? Taxable value is 80 lakh rupees. On this 80 lakh rupees, additionally TCS will be collected. TCS at the rate of 0.1%. TCS at the rate of 0.1%. In excess of 50 lakh rupees means what? 80 lakhs minus 50 lakhs into 0.1%. How much? That means 30 lakhs into 0.1%. How much? 3,000. Seller will collect from the buyer 80 lakh 3,000 rupees. Seller will collect from the buyer 80 lakh 3,000 rupees. Now, buyer is required to pay 80 lakh 3,000 rupees. Buyer is required to pay 80 lakh 3,000 rupees to the seller. Buyer is required to pay 80 lakh 3,000 rupees to the seller. Seller will recognize 80 lakh rupees as sales. Balance 3,000 rupees. Balance 3,000 rupees. It will be paid to government. Now, did you understand section 206C1H? First condition is during preceding financial year, the turnover of the seller should be greater than 10 crores and seller should sell goods worth more than 50 lakhs to the buyer. Seller should sell goods worth more than 50 lakhs to the buyer. At that time, seller, along with collecting taxable value, additionally he needs to collect TCS at the rate of 0.1% in excess of 50 lakh rupees. Whatever the TCS that is collected, it will be paid to the government. Whatever the taxable value that is collected, it will be recognized as sales. Have you understood? So I gave brief introduction about 206C1F and 206C1H, and one more point is there. There will be chain, right? Manufacturer, wholesaler, distributor, retailer, customer. On sale of goods from manufacturer to wholesaler, wholesaler to distributor, distributor to retailer. In all these transactions, section 206C1H, section 206C1H is applicable. Section 206C1H is applicable. Reverse to section 206C1F. Reverse to section 206C1F. Have you understood? However, on sale by retailer to customer, section 206C1H is not applicable. Section 206C1H is not applicable. Have you understood? This is the brief introduction about section 206C1F and section 206C1H. Have you understood till here? Now I am going to explain you the amendments. Receipt of sale consideration from a dealer would be subjected to TCS under section 206(1)H if such sales are not subjected to TCS under section 206(c)(1)F. What do you mean by this? There is retailer, there is also customer, Retailer sold one Swift car to customer. Value of the car is 8 lakh rupees. Value of car is 8 lakh rupees. Whether TCS is required to be collected under section 206(c)(1)F or not. Whether TCS is required to be collected under section 206(c)(1)F or not. Under section 206(c)(1)F, TCS is required to be collected only if the value of the car is greater than 10 lakh rupees. Here value of the car is less than 10 lakh rupees. Whether TCS is required to be collected? No. Value of the car less than 10 lakh rupees. No TCS under section 206(c)(1)F. No TCS under section 206(c)(1)F. See, for each single transaction, for each single car, we will check the threshold limit of 10 lakh rupees. However, he bought 10 Swift cars. He bought 10 Swift cars. What is the value? Value will be 80 lakhs. In this case, whether TCS is required to be collected under section 206(c)(1)F or not. In this case, whether TCS is required to be collected under section 206(c)(1)F or not. TCS is not required to be collected under section 206(c)(1)F. The reason is individually for each car the value of the car is less than 10 lakh rupees. So in this case section 206(c)(1)F is not applicable. However, section 206(c)(1)H is applicable because the overall transaction is greater than 50 lakhs. Have you understood? On sale by retailer to customer, individual car cost is less than 10 lakh rupees. So how many cars that are being sold? Still section 206C1F is not applicable because the value of each car is less than 10 lakhs. However, in aggregation of all cars, if value of all cars that are sold is greater than 50 lakhs, then section 206C1H is applicable. Is it clear? Have you understood? In case of sale to consumer, receipt of sale consideration for sale of motor vehicle of the value of 10 lakhs or less to a buyer would be subjected to TCS under section 206C1H if receipt of sale consideration for such vehicles during previous year exceeds 50 lakhs during the previous year. Have you understood? In case of sale to consumer, receipt of sale consideration of sale of motor vehicle of the value exceeding 10 lakh rupees would not be subject to TCS under section 206C1H if such sales are subjected to TCS under section 206C1F. What do you mean by this? What do you mean by this? There is retailer. There is also customer. Retailer turnover during preceding financial year is greater than 10 crores. Retailer turnover during the preceding financial year is greater than 10 crores. Now, retailer sold BMW to customer. Retailer sold BMW to customer. Value of car is 70 lakh rupees. Value of car is 70 lakh rupees. In this case, whether 206C1F is applicable or 206C1H is applicable. There is chance for applicability of 206C1H because individual transaction is also greater than 50 lakhs. In this case, section 206C1F is applicable. Prima facie section 206C1F is applicable because the individual value of the car is greater than 10 lakhs. When section 206C1F is applicable, then section 206C1H is not at all applicable. Is it clear? Have you understood? Is it clear? That's what the amendment is. It's not amendment, it is the clarification that is given by the department. There is one last point, note point, adjustment of sale return, discount or indirect taxes. See, once TDS is deducted or once if TCS is collected, if later on if any sales returns happens, then it will not have any impact on TCS collected amount. Once if TCS is collected, it will be deposited to the government. It will again cannot be taken back. It cannot be taken back. Even though there is sales return, even though there is discount, even though there is GST issues, still if TCS is collected and deposited to the government, there will be no change there afterwards. Are you able to understand? That's what the note point is. With this, we have concluded part 2. Thank you very much. Bye. So we discussed the TDS amendments, right? Only one amendment is pending, that is section 201. In order to explain this amendment, first of all, you need to have knowledge regarding 40A1 and 40A1A. Actually, we discussed these provisions in the class. I think you would have remember. Once again, I will revise this. There will be two parties, payer and payee. 40A1 is applicable in case of payment made to non-resident. 40A1A is applicable in case of payment made to resident. So, payer at the time of making payment to payee. Payer has two obligations. What are they? He needs to deduct TDS. On or before 31st March. He needs to deduct TDS on or before 31st March. What is second responsibility? Deducted TDS is required to be deposited. On or before due date for filing ITR under section 139(1). On or before due date for filing ITR. Under section 139(1). What is the conjunction? Conjunction is and. That means both the conditions are required to be satisfied. Both the conditions are required to be satisfied. If any one of the condition is not satisfied, if any one of the condition is not satisfied under section 40A1, that means in case of payment made to non-resident, 100% of the expenditure is disallowed. Under 40A1A, in case of payment made to resident, 30% of the expenditure is disallowed. Under 40A1A, 100% of the expenditure is disallowed. Under 40A1A, 30% of the expenditure is disallowed. Have you understood till here? 40A1 speaks about payment made to non-resident. 40A1A speaks about payment made to resident. Payer at the time of making payment to the payee, payer has two obligations, two responsibilities. First one is payer need to deduct TDS on or before 31st March of the previous year. Second obligation is deducted TDS has to be deposited to the government on or before the due date for filing ITR under section 139(1). The conjunction between these two conditions is and. That means both the conditions are required to be satisfied. If any one of the condition is not satisfied, under 40A1, if payment is made to non-resident without deduction of TDS, or if deducted TDS is not deposited to the government, then 100% of the expenditure paid to non-resident is disallowed. Under 40A1A, that means in case of payment made to resident, if TDS is not deducted or deducted TDS is not deposited to the government, then 30% of the expenditure is disallowed. Are you able to understand? However, there is an exception to this disallowance. Exception to disallowance means what? In such an exception, even though TDS is not deducted or deducted TDS is not deposited to the government, still expenditure is not disallowed and expenditure is allowed. What is that? What are the conditions that are required to be satisfied? 4 conditions are required to be satisfied. First condition is payee has to file his income tax return. Second condition is payee has to show that expenditure, whatever the expenditure to the payer is there, that expenditure is required to be shown as income by the payee in his income tax return, and payee has to pay discharge tax liability in his income tax return. Fourth condition is chartered accountant report is required to be obtained, that the first 3 conditions are satisfied, and chartered accountant report is required to be submitted. If these 4 conditions are satisfied, disallowance will not get attracted. Disallowance will not get attracted means what? Even though TDS is not deducted, even though deducted TDS is not deposited to the government, still expenditure is not disallowed and expenditure is allowed. Are you able to understand? The best example, I gave example of my audit fees. Let us see this with an example. For example, on 10th October 2022, Mr. A paid audit fees of rupees 1 lakh, to Mr. USM. On 10th October 2022, Mr. A paid audit fees of rupees 1 lakh to Mr. USM. This is the thing. However, Mr. A at the time of making payment of rupees 1 lakh, he did not deduct TDS. Now, if any payment is made to resident and on such payment TDS is not deducted, whether expenditure is allowed? Yes, expenditure is allowed, but only 70% of the expenditure is allowed, 30% of the expenditure is disallowed. That means out of 1 lakh rupees, this will be classified into 2. Out of 1 lakh rupees, 30,000 is disallowed. Balance 70,000 is allowed. Balance 70,000 is allowed. In this case, this 30,000 is disallowed, right? 30,000 being 30% of the expenditure is disallowed. This disallowance does not get attracted. If 4 conditions are satisfied. First condition, Mr. USM filed his income tax return. Mr. USM filed his ITR. Second condition, he considered payment made by, or ila rayachu, he disclosed payment made by Mr. A as his income in ITR. Third condition, tax liability is discharged on such income. Tax liability is discharged on such income. Tax liability is discharged on such income. What is fourth condition? CA report is obtained. CA certificate is obtained. That above three conditions are satisfied. Obtained. That above three conditions are satisfied. That above three conditions are satisfied. If these four conditions are satisfied, what is the conjunction? Conjunction is and. All the four conditions are required to be satisfied. All the four conditions are required to be satisfied. So what is the conjunction? Conjunction is and. If all these four conditions are satisfied, then disallowance does not get attracted. Then 30,000 expenditure is not disallowed and 30,000 expenditure is allowed. 30,000 expenditure is allowed. If above four, if all of the above. If all of the above four conditions are satisfied, then disallowance will not get attracted. Disallowance will not get attracted. That means entire audit fees is allowed as expenditure to the payer. Entire audit fees of rupees 1 lakh. Entire audit fees of rupees 1 lakh is allowed as expenditure to the payer. Is allowed as expenditure to the payer. Have you understood till here? Generally, at the time of making payment to non-resident or at the time of making payment to resident, if any one of those two conditions are not satisfied, expenditure is disallowed. In case of non-resident, 100% of the expenditure is disallowed. In case of resident, 30% of the expenditure is disallowed. However, such disallowance will not get attracted if all these four conditions are satisfied. That means if all these four conditions are satisfied, that expenditure is allowed as deduction. There is no miscompliance. The thing is, in this example, when payment is made by Mr. A to Mr. USM, payment is made on 10th October 2022. That means during previous year 22-23. During previous year 22-23. But when Mr. USM can file his income tax return? See, for previous year 2023, what is the assessment year? Assessment year is 23-24. For example, let's say he is resident individual, and for him audit is not applicable. In this case, when he is going to file his income tax return on 31st, on or before 31st July of the assessment year. That means what? Let's say there is previous year 22-23. For previous year 22-23, what is the assessment year? Assessment year is 23-24. For previous year 22-23, assessment year is 23-24. TDS is required to be deducted on 10th October 2022. TDS is required to be deducted on 10th October 2022. But whether SSC deducted TDS or not, he did not deduct TDS. When Mr. USM is filing income tax return, he is filing income tax return on or before 31st July 2023. Actually, on this date, TDS is required to be deposited to the government. On this date, TDS is required to be deposited to the government. But when actually tax is going to the government? Actually, tax is going to the government on 31st July 2023. Whatever the time gap that is there, during this time gap, interest is levied. At the rate of 1% per month or part of the month. You can read, where payer fails to deduct whole or any part of the tax on the amount credited or payment made to a payee and is not deemed to be SSE in default under section 201 on account of payment of taxes by such payee. Interest under section 201(1)(a) at the rate 1% per month or part of the month shall be payable by the payer from the date on which such tax was deductible to the date of furnishing of return of income by such payee. That means what? In this case, SSE is not regarded as SSE in default because all the four conditions are satisfied. However, the government is losing interest, right? Actually, TDS is to be deposited on 10th October 2022, but actually tax payment is done on 31st July 2023. Whatever the time gap is there, in this time gap, the government is losing interest. The government is losing interest. So, for this time period, interest is levied at the rate of 1% per month or part of the month or part of the month or part of the month under section 201(1)(a), under section 201(1)(a). Are you able to understand? Is it clear? So October, November, December, January, February, March, April, May, June, July. How many months are there? 10 months, right? 10 months are there. So for 10 months, how much interest is levied? Interest under section 201(1)(a). So what is the TDS that is required to be deducted? In case of professional fees, what is the rate of TDS? 10%, right? 1 lakh into 10%, 10,000 under section 194J. Do you remember? 194J. So amount of TDS is 10,000. 10,000 into 1% into 10 months. How much? 1,000. So 1,000 interest under section 201(1)(a) is required to be paid to the government. Are you able to understand? Is it clear provision now? First of all, SSE did not deduct TDS, or SSE after deducting TDS, he did not deposit TDS to the government. Generally, whatever the expenditure that is paid by the SSE, it is disallowed. However, disallowance did not get attracted because four conditions are satisfied. Because of that, expenditure is not disallowed. Although expenditure is not disallowed and expenditure is allowed, whatever the time gap that is there in between time of deduction of time, like the time at which TDS is required to be deducted and the due date for filing ITR. During this period also interest will be levied under section 201(1)(a). Are you able to understand? Is it clear? So from the date on which tax was deductible to the date of furnishing return of income by such payee. So the date on which SSE is required to deduct TDS, from that date onwards, the date on which return was filed by the payee. During this cap, whatever the period is there, for such period, interest under section 201(1)(a) gets attracted. Are you able to understand? Let's say individual filed his income tax return on 26th July 2023. 26th July 2023 means it is also a part of the month, right? So he is required to deduct TDS on 10th October 2022. That means from October 2022 to June 2023. Gap of 10 months. There is a gap of 10 months. For these 10 months, interest under section 201(1)(a) gets attracted. Are you able to understand? So with this, we have concluded amendments relating to TDS. Next, there are amendments relating to provisions for filing return of income and self-assessment. There is a new return under section 139(8)(a) called updated return. This is also called as ITRU. What do you mean by this updated ITR? This ITRU came into force. From 1st April 2022. And this gives privilege. ITRU gives privilege to file income tax return for assessment year 2021 and assessment year 21-22. Assessment year 2021 means previous year 1920, previous year 2021. Generally, for previous year 1920, for previous year 1920, what is the assessment year? Assessment year is 2021. Assessment year is 2021. For example, assessment year 2021 got over. Assessment year 2021 got over. Whether income tax return for previous year 1920 can be filed or not. ITR for previous year 1920 can be filed or not. How? Generally, it cannot be filed. There is section 139(1) which speaks about original return. Due dates for original return 31st July or 31st October. Do you remember 139(4)? Yes, it is belated return. It is belated return. As per belated return means what? Filing return of income after the due date under section 139(1). Even to file belated return also, there are time limits. Belated return can be filed on or before 31st December of the assessment year or before completion of the assessment, whichever is earlier. There is another return under section 139(5). This is called as revised return, right? This is called as revised return. Even in order to file revised return also, there are time limits. Revised return can be filed on or before 31st December of the assessment year or before completion of the assessment, whichever is earlier. Now for previous year 1920, what is the assessment year? Assessment year is assessment year 2021. Once assessment year gets over, belated return cannot be filed. Revised return can also be not filed. Revised return cannot be filed. Belated return cannot be filed. However, if any person wants to file ITR for previous year 1920, he can file using updated ITR. He can file using updated ITR. Okay. He can file using updated ITR up to 24 months from the end of the previous year. From the end of the assessment year. From the end of the assessment year, he can file updated ITR for a period of 24 months. Are you able to understand? For previous year 1920, what is the assessment year? Assessment year is assessment year 2021. For assessment year 2021, what is the last date? Last date is 31st March 2021. From 31st March 2021 onwards up to 24 months. Up to 24 months. Up to 24 months means what? Up to 31st March 2022. Up to 31st March 2023. That means income tax return of previous year 1920 can be filed up to 31st March 2023. Income tax return of previous year 1920 can be filed up to 31st March 2023. Are you able to understand? The same concept applies. Generally, after the end of the assessment year, from the last day of the assessment year, for the next 24 months also, income tax return can be filed for the previous year. Are you able to understand? What is the current previous year? Current previous year is previous year 22-23. Current previous year is previous year 22-23. What is the assessment year? Assessment year is 23-24. Assessment year is 23-24. What is the last date for filing in belated return for previous year 20-23? Last date for filing belated return for previous year 20-23 is 31st December 2023. 31st December 2023. After 31st December 2023, belated return cannot be filed. Revised return can also be not filed. However, updated return can be filed. Updated return can be filed. Up to which time updated return can be filed? Up to 31st March 2024 up to 31st March 2025. That means from the end of the assessment year, up to next 24 months also, updated return can be filed. Are you able to understand? Up to 30, like in this period, ITRU can be filed. Now, are you able to understand when ITRU can be filed? From the last day of the assessment year, up to the next 24 months, updated ITR can be filed. Have you understood? హౌస్ ప్రాపర్టీకి సంబంధించి Even though return is not filed, still loss can be carry forwarded. There is no such rule that ITR is mandatorily required to be filed. So now have we understood when ITRU can be filed? After the end of the assessment year, not previous year. After the end of the previous year, return under section 139.1 or 139.4 or 139.5. That means original return, original return, belated return or revised return can be filed. After time limits of revised return and belated return from the end of the assessment year, for the next 24 months also, income tax return of the previous year can be filed. That income tax return we call as updated return or updated ITRU, updated return or ITRU. Are you able to understand? Now, have you understood up to this point? So you can read a point. Any person may furnish an updated return of his income or the income of any other person in respect of which he is assessable for the previous year relevant assessment year at any time within 24 months from the end of the relevant assessment year. That means you need to consider the last day of the assessment year. From the last day of the assessment year for the next 24 months, updated ITRU can be filed. This is irrespective of whether or not he has furnished a return of income under section 139.1 or belated return under section 139.4 or revised return under section 139.5 for that assessment year. What do you mean by this? During previous year 2023, whether ITR under section 139.1 filed or not, whether ITR under section 139.1 filed or not, or ITR under section 139.4 filed or not, or ITR under section 139.5 filed or not. Even then ITRU can be filed. Are you able to understand? For previous year 2023, income tax return is not filed. Still ITRU is filed. ITRU can be filed. For previous year 2023, ITR is filed. Income tax return is filed. Time to revise got over. That means revised return time limits are also got over. Still ITRU can be filed. Are you able to understand? So you have filed belated return. Even belated return can also be revised using ITRU. Are you able to understand? Even belated return can also be revised using ITRU. That means during previous year, for whatever the previous year that is there, whether in assessment year ITR is filed under section 139.1 or not, ITR is filed under section 139.4 or not, ITR is filed under section 139.5 or not, still updated ITR can be filed. Are you able to understand? Irrespective of whether original income tax return or revised return or belated return, whether they are filed or not, still there is a chance to file updated ITR. Is it clear? Or we can simplify this. During assessment year 2023, whether ITRU can be filed or not, During assessment year 22-23, original return filed under section 139.1. Whether ITRU can be filed? Yes, ITRU can be filed. During assessment year 2023, belated return was filed. Under section 139.4. Whether ITRU can be filed? Yes, it can be filed. Revised return is filed. Under section 139.5. Whether ITRU can be filed? Yes, ITRU can be filed. No income tax return is filed. Whether ITRU can be filed? Yes, ITRU can be filed. Are you able to understand? Even though no income tax return is filed during the assessment year, still ITRU can be filed. Are you able to understand now? So ITRU can be filed irrespective of whether income tax return is filed or not during the assessment year. Is it clear? Have you understood? ఎందుకంటే రివైజ్డ్ రిటర్న్ ఫైల్ చేయడానికి టైం లిమిట్ అయిపోయింది కాబట్టి. రివైజ్డ్ రిటర్న్లో కూడా మిస్టేక్ కనిపించింది. No, it cannot be revised. I will tell that point. Have you understood? Time limit for filing revised return is on or before 31st December of the assessment year or before completion of assessment, whichever is earlier. The time limit got over. Now revised return cannot be revised. So updated return can be filed. Are you able to understand? Is it clear? So have you understood first point? Updated return for assessment year 23-24 can be filed up to 31st March 2026. That's what we have written here, right? Sorry, 31st March 2025, 31st March 2024, 31st March 2025. Hold on. Assessment year ending is 31st March 2024. From then 2 years means 31st March 2025, 31st March 2026. Have you understood? Now, non-applicability of provisions of updated return. The provisions of updated return would not apply. Provisions of updated return would not apply if updated return of such person for that assessment year is a loss return or has the effect of decreasing the total tax liability determined on the basis of return furnished under section 139(1) or section 139(4) or 139(5) or results in refund or increases the refund due on the basis of return furnished under section 139(1) or 139(4) or 139(5. What do you mean by this? Now we will compare return filed under section 139(1) or 139(4) or 139(5. What do you call this return? Original return or revised return or belated return. This we will compare with ITRU. 139(5). Yeah. Whether it is possible or not, that we have to tell. Whether it is possible or not, that we have to tell. First of all, in return filed under section 139(1) or 139(4) or 139(5, the tax liability is, let's say, 60,000 rupees. Tax liability is 60,000 rupees. He wants to file ITRU. Under ITRU, the tax liability is 55,000. The tax liability is 55,000. Whether ITRU can be filed, it cannot be filed. ITRU cannot be filed if it has the effect of decreasing the tax liability. ITRU cannot be filed if it has the effect of decreasing the tax liability. Next. The tax liability under section 139(1), 139(4) or 139(5 is 60,000 rupees. Tax liability as per ITRU is 75,000. Whether ITRU can be filed? Yes, ITRU can be filed. Are you able to understand? Under return filed under section 139(1), 139(4) or 139(5, there is refund of 30,000. There is refund of 30,000. Under ITRU, there is refund of 35,000. There is refund of 35,000. Whether ITRU can be filed? No, ITRU cannot be filed. See, entire provisions, ITRU is entirely in favor of income tax department. There is refund of 30,000 rupees. There is refund of 30,000 rupees. There is refund of 30,000 rupees. Now, as per ITRU, there is refund of 20,000. There is refund of 20,000. Whether ITRU can be filed? Yes, ITRU can be filed. Next, in the income tax return that is filed originally, there is loss of 50,000 rupees. There is loss of rupees 50,000. There is loss of rupees 50,000. Under ITRU, he wants to claim loss of rupees 90,000. He wants to claim loss of rupees 90,000. Whether ITRU can be filed? ITRU cannot be filed. As per original return, there is loss of rupees 50,000. As per updated ITR, there is loss of rupees 10,000. Whether ITRU can be filed? Yes, ITRU can be filed. Are you able to understand? So ITRU can be filed only if there is decrease in loss, if there is increase in tax liability, if there is decrease in refund amount, entirely in favor of income tax department. If there is decrease in tax liability or increase in refund or increase in loss, ITRU cannot be filed. Have you understood with example? Next, circumstances in which updated return cannot be furnished. That means there are some cases in which ITRU cannot be furnished. What are those cases? No updated return can be furnished by any person for the relevant assessment year where an updated return has been furnished by him under this subsection for the relevant assessment year. What do you mean by this? If an updated return is filed, updated return cannot be revised. Updated return cannot be revised. Hope your doubt got solved now. Okay. If you file an updated return, okay, there is no scope for filing revised return of updated return. Are you able to understand? You can write it simply. ITRU cannot be revised. ITRU cannot be revised. Any proceeding for assessment or reassessment or recomputation or revision of income is pending or has been completed for the relevant assessment year in his case. That means what? For that particular previous year there will be assessment year. If during the assessment year already assessment is completed by the department, already assessment is completed by the income tax department. Once assessment is completed, then SSC cannot file ITRU. Then SSC cannot file ITRU. You know assessment, right? The income tax officer will verify the income tax return and he will give the like after completion of the assessment, he will process the income tax return. Once income tax return is processed, or once assessment is completed, again ITRU cannot be filed. He such person belongs to such class of persons as may be notified by CBDT. There are other circumstances also in which updated return cannot be furnished for the relevant assessment year, where prosecution proceedings are initiated under the relevant provisions of Income Tax Act 1961. Prosecution proceedings means what? They will arrest the SSC. Income Tax Department will arrest the SSC. Those kind of situations, they are not covered at CA inter level, they are covered at CA final level. At that point of time, you will come to know. Okay, prosecution means nothing but arresting the person and keeping him in jail. So under Income Tax Act, if any steps were taken to arrest the SSC, in such a case also SSC cannot file ITRU. Next, this point, this is very interesting. Updated return can be filed if original return is a loss return and updated return is a return of income, If any person has a loss in any previous year and has furnished a return of loss on or before the due date of filing return of income under section 139, he shall be allowed to furnish his updated return if such updated return is a return of income. What do you mean by this? In order to understand this concept, you need to have deeper knowledge. During previous year 1920, there is a loss of, let's say, 50 lakhs. There is a loss of 50 lakhs. During previous year 2021, there is income of there is income of let's say 20 lakhs, there is income of let's say 20 lakhs. Now this loss will be set off, right? Loss from previous year 1920 can be set off against income of previous year 2021. How much loss can be set off? 20 lakhs loss can be set off. Balance will be nil. During previous year 21-22, during previous year 21-22, there is income of let's say 10 lakh rupees. There is income of 10 lakh rupees. Loss will be carry forwarded, right? Loss from 1920, 10 lakhs will be set off. 10 lakhs will be set off. Balance will be nil. However, during previous year 22-23, during previous year 22-23, tell me whether during previous year 2023, ITRU can be filed for previous year 1920 or not. Previous year 1920 means nothing but assessment year 2023. Whether ITRU can be filed or not. Whether ITRU of previous year 1920 can be filed or not. Didn't you understand? For previous year 1920 assessment year is 2021. End of assessment year is 31st March 2021. From end of assessment year up to 24 months. That means up to 31st March 2023 ITRU can be filed. Up to 31st March 2023 ITRU can be filed. Now there is loss written, right? Loss of 50 lakh rupees during 22-23. During 2023 ITRU of previous year 1920 was filed. ITRU of previous year 1920 is filed. In ITRU of previous year 1920, there is income of let's say 5 lakh rupees. There is income of let's say 5 lakh rupees. That means SSC initially he disclosed loss of 50 lakh rupees. Initially he disclosed loss of 50 lakh rupees during previous year 1920. Now he is telling that there is no loss of 50 lakh rupees in updated ITR. In ITRU he is telling that there is income of 5 lakh rupees. There is income of 5 lakh rupees. Now he cannot set off 20 lakh rupees, right? He also cannot set off 10 lakh rupees. That means because of filing ITRU of previous year 1920 in previous year 2023, there is impact on income tax return of previous year 2021. There is impact on income tax return of previous year 21-22. Now when this ITRU is filed, ITRU of previous year 2021, ITRU of previous year 21-22 is also required to be filed. Are you able to understand? Is it clear? Because of filing ITRU of previous year 1920 in previous year 2023, there is impact on previous year 2021 income, previous year 21-20 income also. That is why when this ITRU is filed, ITRU of 2021, ITRU of 21-20 is also required to be filed. Are you able to understand? Is it clear? Actually, initially it is a loss return. When filing ITRU, he disclosed, that means he converted loss return into return of income. When initially he disclosed loss return, and in subsequent years also he set off that loss with income. Now because of disclosing income in the ITRU, it has effect in income like in ITR of previous year 2021 and previous year 21-22. That's why ITRU of previous year 2021 and previous year 21-20 is also required to be filed. Have you understood? Is it clear? If Mr. X has furnished his return of loss for assessment year 2023 on 31st May 2022 consisting of 5 lakhs as business loss, he can furnish an updated return for assessment year 2023 up to 31st March 2025 if such updated return is a return of income. Updated return to be furnished for subsequent previous year. That's what we have done here, right? Even for subsequent previous years also we have furnished updated return. The reason is because of conversion of loss return into return of income. It has impact in subsequent years. So for subsequent years also it becomes mandatory to file ITRU. Is it clear? Next. Tell me the range for previous year 22-23. What is the assessment year? Assessment year is 23-24. What is the end of assessment year? End of assessment is 31st March 2024. From this date onwards up to 24 months, right? Up to 24 months, ITRU can be filed. Up to 24 months means up to 31st March 2026. Up to 31st March 2026, ITRU can be filed. This we can divide into two parts. Up to 31st March 2025, which is 12 months, first 12 months, up to 31st March 2026. That means up to 24 months. Up to 24 months. Why I have divided like this? I will tell you. If ITRU is filed within first 12 months, then we will arrive at a tax liability, right? From the tax liability, what we will reduce? We will reduce TDS or TCS. We will reduce advance tax. We will reduce relief under section 89. We will reduce relief under section 89. If there is AMT credit, we will also claim that. Ultimately, we will arrive at some tax payable. To this tax payable, what we will do? We will add interest under section 234A. We will add interest under section 234A, 234B, 234C. And we will also add late fees under section 234F. Do you remember? We will also add late fees under section 234F. If all these are added, we will arrive at final tax liability. This is general procedure. Do you remember? This is general procedure. However, if ITRU is filed, in addition to this final tax liability, we also required to pay additional 25% of tax. If it is filed within first 12 months. Are you able to understand? One second, hold on. Here you can see 25% of aggregate of tax and interest payable as determined above. If it is filed within 12 months from the end of the relevant assessment year. If it is filed within 24 months from the end of the relevant assessment year, 50% of aggregate of tax and interest payable. Okay. So to this final tax liability, if ITRU is filed, punishment, because after the end of the assessment year also government gave permission, government gave eligibility to file updated return, right? So when updated return is filed along with normal tax liability, additionally 25% of the tax liability will also be levied. We will add 25% of aggregate of tax and interest. 25% of aggregate of tax and interest. When if filed within 12 months. Or 50% of aggregate of interest and tax. 50% of aggregate of tax and interest. When if ITRU is filed. If ITRU is filed within 24 months. If ITRU is filed within 24 months. Are you able to understand? And we will arrive at ultimate tax liability. This is required to be paid to the government. Have you understood? First we will take whatever the tax payable that is there, including health and education cess. From the tax liability, already if TDS is deducted, we will reduce TDS. We will reduce advance tax. We will reduce relief under section 89. We will also reduce AMT credit. To that we will add interest under section 234A, interest under section 234B, interest under section 234C. For late filing of income tax return, if there is any late fees under section 234F, even that is also to be added. To that final tax liability, if ITRU is filed within 12 months, then 25% of the aggregate of tax and interest will be added. If ITRU is filed within 24 months, then 50% of the aggregate of tax and interest will be added, and we will arrive at ultimate tax liability. Have you understood? Is it clear? This is the case if no ITR is filed. If no ITR is filed previously. If no ITR is filed previously. If no ITR is filed previously. If ITR is filed previously, then what would be the consequence? If ITR is filed previously. If ITR is filed previously, then along with reducing TDS TCS advance tax, relief under section 89(1) and AMT credit, additionally we will also reduce tax paid as per ITR filed. We will also reduce that one. Are you able to understand? Is it clear? If no ITR is filed, if no income tax return is filed, we will reduce all these aspects. However, if already income tax return is filed, whatever the tax that is paid as per that return, we will also reduce that. Is it clear? And interest under section 234A, 234B, 234C. If it is already paid, see, as per original return, interest under section 234A, 234B, 234C would have already paid, right? Now here we will add only additional interest under section 234A, 234B and 234C. Have you understood? Now we will pay only additional interest. We do not pay original interest. If already ITR is filed, again ITRU is being filed. At that point of time, in ITRU, whatever the additional interest under section 234A is there, whatever the additional interest under section 234B is there, whatever the additional interest under section 234C is there, only additional interest will be paid at the time of filing ITRU. Is it clear? Have you understood? Or do you guys having any doubt? Is it clear up to here? So this is the concept relating to updated ITRU. Recent amendment. There is a scope to be asked. My guess is he may not ask in up to this much depth, but he might ask regarding up to which period ITRU can be filed. It can be filed up to 24 months from the end of the relevant assessment year. If ITRU is filed within 12 months from the end of the relevant assessment year, you need to remember this point. 25% of the aggregate of tax and interest will be levied. If ITRU is filed within 24 months from the end of the relevant assessment year, then 50% of the aggregate of tax and interest will be levied. Within 12 months, 25% of the aggregate of tax and interest will be levied. Within 24 months, that means from 12 months to 24 months range. From 12 months to 24 months range, 50% of the aggregate of tax and interest will be levied. On which amount it is levied, we have seen, right? If no ITR is filed, this is the format. If ITR is filed, whatever the tax that is paid as per ITR, that can be reduced, and only additional interest under section 234A, 234B, 234C will only be paid at the time of filing ITR. You can write like this: required to be paid at the time of filing ITRU. Is it clear? Is it clear? Next, 139.9 defective return. See, at the time of filing updated return, additional tax liability will be paid, right? If it is filed within 12 months, 25% of the additional tax liability will be paid. If it is paid within 24 months, from 12 months to 24 months, 50% of the additional tax liability will be paid. After paying additional tax liability, the income tax department will issue challan. Income tax department will issue challan. This challan is required to be submitted at the time of filing ITRU. At the time of filing ITRU, if this challan is not submitted, then ITRU will be considered as defective return. Are you able to understand? Before filing updated return, you need to pay additional tax liability, 25% of additional tax liability or 50% of additional tax liability. After you make additional tax liability, you will receive challan. That challan is required to be attached at the time of filing ITRU. If challan is not attached, then ITRU will be considered as defective return. Defective return means what? Even the return is filed, still it will be considered as no ITR is filed. Okay. Next. Quoting of Aadhaar number. Nothing but linking of Aadhaar with PAN. You would have heard this concept, right? Linking of PAN number with Aadhaar number. The thing is 1st July 2017. From 1st July 2017 onwards, if any person wants to obtain PAN number, automatically his PAN number is linked with Aadhaar number. His PAN number is linked with Aadhaar number. Before 1st April 2017, the person who has obtained his PAN number is not linked with his Aadhaar number. His PAN number is not linked with his Aadhaar number. So the government is requesting all the SSCs, all the persons to link his PAN number with Aadhaar number. The government announced the last date to link Aadhaar with PAN is 31st March 2022. If PAN and Aadhaar is not linked on or before 31st March 2022, then PAN number becomes inoperative. However, there is a new section that is introduced called late fees under section 234H. That means up to 31st March 2022, there is a chance to link PAN number with Aadhaar number. If after 31st March 2022, if PAN number is not linked with Aadhaar number, the PAN becomes inoperative. Now, PAN becomes inoperative. Now, there is a date called 30th June 2022. If PAN and Aadhaar is linked in between this time, okay, that means from 1st April 2022 to 30th June 2022, late fees of rupees 500 will be levied. If 500 is paid, and then if PAN number is linked with Aadhaar number, whatever the PAN number that became inoperative, again it becomes operative. After 30th June 2022, that means from 1st July 2022 up to 31st March 2023, if during this period PAN number is linked with Aadhaar, then late fees of 1000 rupees will be levied under section 234H. Are you able to understand? Is it clear? Up to 31st March 2022, there is a time limit to link PAN number with Aadhaar number without any fees. After 31st March 2022, if it is not linked, then PAN becomes inoperative. If PAN is inoperative and if late fees of 500 rupees is paid up to 30th June 2022 and PAN number is linked with Aadhaar, then whatever the inoperative PAN is there, it again becomes operative. If late fees is not paid up to 30th June 2022. From 1st July 2022 onwards up to 31st March 2023, late fees of 1000 rupees will be levied. That means first 1000 rupees is required to be paid to the income tax department. Then PAN number should be linked with Aadhaar. Once PAN number gets linked with Aadhaar, whatever the PAN that is inoperative is there, it again becomes operative. Is it clear? This late fees is levied under which section? Under section 234H. Next, section 234A. interest on default in furnishing return of income. Generally, if return of income is not filed within the due date, then interest under section 234A will be levied. Interest under section 234A will be levied. Interest under section 234A will be levied on tax liability amount. However, interest under section 234A will not be levied on additional tax which is paid under section ITRU. Additional tax. See, within 12 months of filing ITRU, you need to pay additional 25% tax liability. If ITR is filed in between 12 months to 24 months, then additional tax liability is paid. 50% of the additional tax liability is paid. On this additional tax liability, interest under section 234A will not be levied. That's what it was said here. Are you able to understand? Next. Requirement of application for allotment of PAN by certain persons. See, some people are mandatorily required to apply for PAN in these cases. What is first case? Every person who intends to deposit cash in his one or more accounts with a banking company, cooperative bank or post office, if cash deposit or aggregate of amount of cash deposit in such accounts during a financial year is 20 lakhs or more. That means what? For example, I am there, I do not have any PAN. I wanted to deposit some amount in bank, not only single bank account, not only in single bank. Okay. See, there is difference between bank account. I have bank account in SBI. In SBI Hyderabad branch, I have SBI account. SBI Guntur, I can have account. In SBI Vijayawada, I can have account. So aggregating all accounts of a single bank along with other banks also. That means how many bank accounts are there for me? In all those bank accounts, if I wanted to deposit aggregately more than 20 lakh rupees, then I should mandatorily have PAN. I should mandatorily have PAN number. Then even if I do not have PAN, I should apply for PAN number. Only if PAN is allotted, then only I can deposit more than 20 lakhs, aggregating in all accounts. Are you able to understand? 20 lakhs deposit not in single bank account. In aggregating all bank accounts, if I wanted to deposit more than 20 lakh rupees, then I should mandatorily apply for PAN. Is it clear? Next. See, this is with regard to deposit cash. This is with regard to withdraw cash. What do you mean by this? If I wanted to withdraw from my bank accounts, not from single bank account, aggregating all bank accounts, if I wanted to withdraw more than 20 lakh rupees, from all bank accounts aggregately, then if I do not have PAN, I should mandatorily apply for PAN. Only if I get PAN number, then only I can withdraw more than 20 lakhs aggregating all bank accounts. Are you able to understand? So every person who intends to withdraw cash from his one or more accounts with a banking company, cooperative bank or post office, if the cash withdrawal or aggregate of amount of cash withdrawal from such accounts during a financial year is 20 lakhs or more, then at least 7 days before the date on which intends to withdraw cash over the specified limit of 20 lakhs or more. That means when he should apply for PAN, at least 7 days before the date on which he wishes to withdraw more than 20 lakh rupees. Are you able to understand? For example, today's date is there. On 1st March, he wants to withdraw more than 20 lakh rupees. 7 days before means what? On February 21st only he must apply for PAN, and after obtaining PAN only he can withdraw more than 20 lakh rupees in aggregation of all bank accounts. Is it clear? Next, any person who intends to open a current account or cash credit account with a banking company or a cooperative bank or post office, he needs to apply for PAN at least 7 days before the date on which he intends to open such account. Do you know current account? Generally, current account is given for business people. So if any business person wants to open a current account, he should mandatorily have PAN. If he does not have PAN, the date on which he applies for current account, before 7 days only he should apply for PAN number. After PAN is allotted, using that PAN he should open the current account. Quoting and authentication of PAN or Aadhaar number by certain persons. See, whoever the persons that are there, just now we have discussed, they should apply for PAN number, right? And their PAN should also be linked with Aadhaar number. And they need to quote PAN number and as well as Aadhaar number also. That's what details here. See these 3 points which we have just discussed. At the time of depositing amount, they should submit their PAN number along with Aadhaar number to the concerned bank or post office or cooperative society. At the time of withdrawal of more than 20 lakhs, at the time of withdrawal of 20 lakhs or more also, they need to deposit, they need to give their PAN number as well as Aadhaar number. At the time of opening current account or cash credit account also, they need to give their PAN number as well as Aadhaar number to the bank, post office or cooperative society, concerned bank, post office or cooperative society. Is it clear? Next. Taxability of deemed income and miscellaneous topics. Where any sum is found credited in books of accounts of the SSC and the SSC offers no explanation, SSC offers no explanation about the nature and source of or the explanation offered is not satisfactory. In the opinion of the assessing officer, the sum so credited may be charged as income of the SSC for that previous year. What do you mean by this? In company's bank account, in company's bank account, in company's bank account, in books, in company's bank account in books, there is a debit of, let's say 30 lakh rupees. There is a debit of 30 lakh rupees. Bank account, that means there is some deposit in bank account. There is some deposit in bank account. In books it will be debited. In banker accounts it will be credited, right? In banker account it will be credited. In banker account it will be credited. So in our bank account which is there with the banker, there is a credit of 30 lakh rupees. There is a credit of 30 lakh rupees. There is a credit of 30 lakh rupees. Now income tax officer came. Income tax officer went through the bank statement. Income tax officer went through the bank statement. Income tax officer noticed that there is 30 lakh rupees that is there in bank account. There is 30 lakh rupees that is there in bank account. Income tax officer asked the SSC. Income tax officer asked the SSC to explain how he earned these 30 lakh rupees. To give explanation about these 30 lakh rupees. Now SSC is not giving any explanation. SSC is not giving any explanation. So, or SSC is giving explanation. SSC is giving explanation that by selling bonda, pakodi and punugu, he earned 30 lakh rupees, which is unsatisfactory. So SSC is not offering explanation, or if any explanation is given by the SSC, that explanation is not satisfactory. Then whatever the amount that is there, whatever the amount that is credited to the bank account, it will be considered as income of the SSC. That is considered as deemed income. So if any amount is created in books of accounts, regarding that amount, if SSC is not offering any explanation, or if any explanation given by the SSC is unsatisfactory, then income tax officer may consider the amount that is created in books of accounts as deemed income of the SSC. Are you able to understand? Once it is considered as deemed income, effective tax rate of 78% will be levied. Now this is the content which is there in bold, like which is highlighted, that got newly added as an amendment. However, where sum so credited consists of loan or borrowing on or any such amount by whatever name called, any explanation offered by the SSC in whose books such sum is credited shall not be deemed to be satisfactory unless the person in whose name such credit is recorded in books of such SSC also offers an explanation about the nature and source of such sum so credited, and such explanation in the opinion of the assessing officer has found to be satisfactory. What do you mean by this? In company bank account, there is credit of 50 lakh rupees. Let's say company name is ABC and ABC Limited. Now income tax officer approached ABC Limited. Income tax officer asked, how did you get 30 lakh rupees in your bank account? ABC Limited told to the income tax officer, these 50 lakh rupees are given as loan by Mr. D. Now income tax officer will not accept straight away. Income tax officer will go to Mr. D. If Mr. D also gives the same explanation, and whatever the explanation that is given by Mr. D is satisfactory, satisfactory, then it will not be considered as deemed income. If Mr. D says, I did not give 50 lakh rupees, I don't know those 50 lakh rupees means, whatever the amount that is credited in books of accounts, that will be considered as deemed income. Are you able to understand? Simply cross check will be done by the income tax officer. At the time of cross checking, if the counterparty, if the other person also says the same thing that is explained by the assessee, then assessing officer will get satisfied. Otherwise, whatever the amount that is credited in books of accounts of the assessee, that will be considered as deemed income. Is it clear? Further, any explanation offered by closely held company. Closely held company means what? Nothing but private company or public company in which, or company in which public are not substantially interested. Further, any explanation offered by a closely held company in respect of any sum credited as share application money, share capital, share premium, or any such amount by whatever name called in accounts of such company shall be deemed to be not satisfactory unless person being a resident in whose name such credit is recorded in books of such company also explains about the nature and source of such income so credited, and such explanation in the opinion of the assessing officer has been found to be satisfactory. What do you mean by this? In company bank account, there is a credit of, let's say 20 lakh rupees. There is a credit of, let's say 20 lakh rupees. Now, income tax officer will come to the company. Income tax officer will verify the books of accounts. Income tax officer found that there is 20 lakh rupees that is credited in books of accounts of the company. Income tax officer asked to give explanation about these 20 lakh rupees. Company said that these 20 lakh rupees are received in the form of share capital, or these 20 lakh rupees are received in the form of share premium. Now what income tax officer will do? He will counter check with the shareholders. See, when this 20 lakh rupees is recorded, shareholders' names will also be recorded, right? From whom these 20 lakh rupees are received, income tax officer will go to their shareholders. Okay, income tax officer will go to shareholders and inquire the same. Okay, income tax officer will ask the shareholders whether they have paid these 20 lakh rupees or not. If shareholders also tells the same, that they have paid 20 lakh rupees, then income tax officer will further investigate. Income tax officer will ask, how did you get these 20 lakh rupees? If income tax officer asks the shareholders to explain about 20 lakh rupees, and if they give proper explanation, then this 20 lakh rupees will not be considered as deemed income. If shareholders does not give proper explanation, then also this 20 lakh rupees will be considered as deemed income. Are you able to understand? See, double cross checking is there. First he will do cross checking, then he will ask how did the shareholder got that income. If the shareholder did not give proper explanation, means this 20 lakhs will be considered as deemed income. Is it clear? These additional conditions would not apply if the person in whose name such sum is recorded is a venture capital fund or a venture capital company registered with SEBI. See, there are these cross-checking provisions are there, right? These cross-checking provisions will not apply if any amount that is created in bank account, if that amount is given by venture capitalist or venture capital fund registered with SEBI, venture capitalist or venture capital fund registered with SEBI. For example, if these 20 lakhs are given by venture capital or venture capitalist or venture capital fund, then assessing officer will not do cross checking. And assessing officer will accept the same. Is it clear? So these are the amendments that are applicable for your attempt. Thank you very much.